governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
Lisa Bramwitz and Tom Keene. Good morning to all of you. Jonathan Farrell on assignment after a late night Australian Grand Prix as well. We got to do a market check. We were so fired up with Terry Haynes of Pangea. We missed it the last time around. Red and green on the screen right now. The VIX comes in under 20, 19.59. BitDog 28,000 showing the enthusiasm there. 2-year yield. Do I care about 4.09? I mean, it's not really a drama number, is it?
It's not the level, it's the direction. It's the fact that people are starting on the margins to rethink a rate hike cycle or a rate cut cycle that they had priced in previously because of potentially higher oil for longer.
Nothing from curve inversion. I'm sorry, the 10-year real yield gets my attention as we compress down. It's sort of a grind. It's not very romantic, but 1.19% on the 10-year real yield gets my attention. And then I go over to Euro Yen. I mean, oil making the splash today, no pun intended, but Euro Yen out to 144.80. That would be stunning if Europe breaks out stronger versus a surprisingly weak yen. I don't think anybody's looking. That's sort of inside baseball.
Right now, what people are pricing in is a likelihood that the EC.
I said inside baseball.
I got
there
that.
Because
you wanted to get to the Mets and how they won?
I watched the Mets for the first time since 1986. Good morning, Len Dykstra. And this Japanese guy they got, Senga, he is phenomenal. He was almost in tears when he came off the mound.
Congratulations that you haven't watched the Mets from 1986 until now, because that means that you really picked some good times.
David Kelly's like, wait, you're a Red Sox fan. Why are you watching the Mets? But it was fun watching the Steve Cohens. They were very good.
Well, that happens occasionally every, couple decades. Listen, it's really going to be interesting to see how, and I just want to go back to crude for a second, because we're seeing more than a 5% pop in Brent crude. And at one point it was more than 8%. And this comes after a quarter of losses, and it comes as the Fed's trying to figure out how to handle this. St. Louis Fed President James Bullard sitting down with Bloomberg's Michael McKee earlier. David Kelly of JP Morgan on the disinflationary camp, talking about possibly upcoming data continuing to show moderation in inflation, writing, quote, softer data may be just enough to keep the Fed from tightening again on May 3rd. While recession is a very close call, slow growth and moderating inflation looks very likely, as does Fed easing and lower long-term interest rates in 2024. So the disinflation camp, do oil prices change that, Tom?
Time will tell. I think it's the magnitude of the price move. A 5% move up to 80, I've got on a chart basis, I need 90 to get, excited, if you will. And frankly, JP Morgan out of their London desk with some huge leadership on the case to get to $100 a barrel. I'm not sure it's there this morning. What we can do on April is get a brief here into the second quarter. We do that with David Kelly, Chief Global Strategist, JP Morgan Asset Management. I'm going to cut to the rewrite of your outlook for the year. Everyone's doing this now. Farrell's got his, John Farrell, look for it, out March 31 is his year ahead view for 9 months. And for you, it's a stunning statement. You're looking for negative job growth, some form of negative non-farm payrolls. It's out there somewhere. How does that change our world?
Well, absolutely. In fact, the Federal Reserve is themselves, as far as I can tell, because if you actually look at their forecast from the middle of March, and you make some reasonable assumptions about labor force growth, their unemployment forecast suggests that we're going to get some negative payrolls, perhaps losing 300,000-400,000 jobs between March and the end of the year. So, yeah, I think that's likely. I mean, it's kind of like you're on a really sunny day and you look at the weather forecast and there's this bad weather coming.
That's
and
called
it's
Rochester,
not here.
New York. In case you didn't know, you just described
Well,
Rochester. Continue.
Well, we can see this coming because we've got fiscal drag. There are fewer individual income tax refunds. We've got all of that. Plus now we've got the credit tightening. Yeah. That's going to be particularly affecting the small business sector, and that is going to slow the economy. And we can see it all over the place. Now, higher oil prices push up the headline CPI number, but they are fundamentally disinflationary for the U.S. economy because they take money out of the hands of lower middle-income consumers, and they will just spend less on other things. So if I were in the Federal Reserve's position here, I would not look at higher oil prices as a reason to get tighter. It's actually a reason to get easier.
Mike Wilson over at Morgan Stanley is an equity guy, goes all economics on us this weekend. And Mike Wilson says, look, M2 growth is the lowest it's been in 60 years, at least 60 years, he said. How does that fold in? I mean, you had the Biden stimulus. Olivier Blanchard talks about a Biden stimulus. You've got this massive shrinking down. Look at the Adam Tooze's wonderful essay here over the weekend. But the bottom line is, how do you fold this new restriction into your equity market analysis?
I don't think M2 tells you very much. I mean, over those 60 years, for about 30 of them, M2 told you something, and after that, it doesn't tell you anything. So I just don't think money supply is in.
But it's cratered.
Well, of course, it has cratered as rates have gone up, and people can get better rates on other instruments outside of M2. But overall, the narrative of a slowing economy, the point is we're on the edge of something, but we're not on the edge of a cliff, we're on the edge of a swamp. We're just going to slowly slide into something pretty weak here, and inflation is going to grind lower, and we just need to have a little patience and let this unfold.
Well, patience is something that this market has none of. And right now you talk about how higher oil prices may actually be even more disinflationary. However, it won't feel that way, and it won't be borne out necessarily in the data. So if the Fed does not cut rates as much as the market is currently pricing, what is the outlook for risk assets?
Well, it's pay me now or pay me later. I mean, if the Fed doesn't cut rates later on this year, they're going to have a more significantly weak problem going into next year, and they're going to cut then. Because remember, there's not going to be any fiscal aid here. There's going to be no fiscal stimulus until 2025 at the earliest, and this economy is going to be sucking for air in 2024 because it's not going to have enough demand. And I don't mean demand for oil, I mean demand for anything. So the economy is going to be slowing, and the Fed's going to have to cut rates in 2024. If they decide not to raise rates on May 3rd, if they decide to cut rates a little earlier before the end of the year, maybe give us one rate cut, that will ease the amount that they have to cut rates in 2024. But they'll have to cut them.
Within negative non-farm payrolls, I mean, they're going to be under extraordinary political pressure.
There also
given
is
negative statistics.
There's also going to be extraordinary weakness, and this has really been the distinction for a lot of strategists talking about the potential for rate cuts, as Tom was talking about, not necessarily being stimulative. In fact, really coming on the heels of a great deal of weakness. You talk about lower long-term yields. How low could 10-year Treasury yields go in a scenario where this is a swamp?
Well, I mean, I think there is a limit there. I don't think we're talking about a one handle or perhaps not, 2 to 2.5. But I think you get, 2.5 to 3.5 in a 10-year Treasury by the time at some stage in 2024. I don't think I hope the Federal Reserve is not going to resume the pattern of trying to get down to a zero lower bound negative real rates. It doesn't work. They've got to get back down to a more normal level of real rates for the long run, assuming a low inflation rate in the long run.
So how do you really get enthusiastic about any risk assets in an environment where people are overly optimistic, in your view, that it can kind of chug along, that we're not going to get negative payrolls prints?
Well, they may be overly optimistic on the real economy, but if you end up in a sort of a swamp, U.S. companies make profits in swamps. Because they like it when it's a little bit soft. They can always argue with the workers, you don't need a pay increase, or we can't give you a pay increase. They can find ways of cutting costs. They can restore margins. So I think that profitability will rise again in 2024. And so long as you've got low rates, that underpins all of financial assets. So, I do think they're cheaper things than U.S. equities. I think international equities are a lot cheaper. But overall, low rates is really the key for risk assets.
I didn't realize this, Lisa. Obviously, negative payrolls, April of 2020, March of 2020, in the pandemic shock. You have to go back to 2010. This is the last time the Mets won. September of 2010 was the last negative statistic on non-farm payrolls.
But going back to 1986, they won the championship, so there you go.
You keep on saying that. I think they beat the Red Sox that year, and I sort of remember with pain, so please don't talk about that.
Lenny Dykstra hit a ball. Oil Can Boyd put that orb in. Dykstra hit it's never come down. It went over Everett, Massachusetts. Last seen northeast of Marblehead.
Just stop it. This is painful.
All right, so let's shift. Let's go back to just sort of the bread and butter, as you're talking about. It's sort of odd to come out with a pretty negative prognostication for the economy, but be really constructive on risk assets to basically say this all paves the way for a pretty good return.
But you could have said that at the start of this year also, and we actually had a pretty good first quarter. Stocks up about 7%, bonds up about 3%. It's been, this is sort of the start of a new quarter for us. We put out our second quarter guide to the markets, which is a big production in my area. And when we look at what happened in the first quarter, you could easily have had that narrative and had the market go down, and it didn't. And I think the reason it didn't is because inflation is gradually coming down. I think people can look at that and they realize that if inflation comes down, the uncertainty caused by sudden spiral inflation is going away. And that's probably the single most important factor for financial markets.
Where are you on cash right now?
Well,
cash got humbled last quarter.
Yeah, and it's not a great long-term investment. What we find is that when you get to peak cash rates, it's good, but you got to reinvest it at some stage, and almost always fixed income actually beats cash over the following year. So it's even though the cash yields are enticing, remember you're going to have to reinvest it.
Guys, what you just heard there from Dr. Kelly is religion. It's gospel. It's not getting out of the market going to cash. It's wildly asymmetric to me. It's the getting back into the market, which is brutal. David Kelly, thank you so much. Really, really appreciate that. David Kelly and I. The Red Sox are in some spirited effort here. Mohamed Al-Arian, watching in England, emails in, Lisa. He's very impressed. Al-Arian's looking at the importance of the oil decision. He's looking at the multi-prudential, the macro-prudential analysis of oil that we'll get from Ed Morrison in a moment. Al-Arian also noticing that Kodai Senga had a win here for the Mets.
Thank you.
On this weekend. Dr. Al-Arian.
LGM,
on
yes.
top of the Mets.
Another Mets fan. Look, this is going to be a really interesting moment, and I do wonder how many other forwards really get completely revised on the heels of what happened during the first 3 months of this year. Honestly, this has been a tremendous roller coaster, and we're poised for yet another one with a lot of disparate views. And to me, the takeaway this morning is people are not shifting. They're hunkering down in their belief and saying either the weather's going to change and you guys aren't buying enough canned goods, or they're saying you guys aren't smelling the roses because the sun's still out.
I've just looked at this, Lisa. Standard & Poor's still negative 10% 1 year trailing. Dow Jones, negative 4% 1 year trailing. NASDAQ 100, I didn't realize this, negative 14%, even with that bang-up first quarter. It was more, to me, all of what Calvasino was talking about, a healing quarter.
Which is the
than
reason,
like a bull market victory.
Well, which is the reason why some people think that tech could keep rallying, because it lost so much, and now it's efficient. Now it's the year of efficiency with all of the job cuts, and other people saying, not so quickly. We haven't actually had the recession yet, so we don't know.
Coming up, a conversation of the day on this news from the Middle East. Edward Morris will join us. He's global head of commodities at Citi Research. Ed Morris on the path to $100 a barrel. Stay with us. Worldwide, this is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A surprising move from OPEC Plus as the coalition makes an oil production cut of more than 1 million barrels a day. Oil futures soared following the new inflation risk. Saudi Arabia led the cartel by pledging its own 500,000 barrel a day supply reduction. The White House said the cutbacks were ill-advised. Former Arkansas Governor Asa Hutchinson is entering the race for the Republican nomination for president. Hutchinson has been critical of former President Trump. He told ABC that people want leaders that appeal to the best of America and not simply appeal to the worst instincts. In Finland, Prime Minister Sanna Marin has lost to a pro-business opposition group in close parliamentary elections. Marin's Social Democrats finished in third place, with the center-right National Coalition declaring victory. Now that puts Petteri Orpo on track to become prime minister. He's overseeing the finance, interior, and agriculture portfolios in two governments. Tesla reported record deliveries in the first quarter. Still, the number fell short of the pace needed to meet Elon Musk's goal of 50% annual growth. The electric vehicle maker delivered almost 423,000 cars after it cut prices. And in sports, LSU is the new champion of women's college basketball. The Tigers beat Iowa 102-85 to win the NCAA title in Dallas. LSU's Angel Reese had 15 points, 10 rebounds, and was named the most outstanding player. It was Coach Kim Mulkey's fourth national title. She won 3 others at Baylor. For Iowa, Caitlin Clark had 30 points. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Our studios in New York and San Francisco. Our new hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television.
This is Bloomberg.
When I think a supply shock like this, I think, okay, well, prices are going to rise. It's going to destroy demand, and that's going to feed into recession. So I think the way it's going to impact on yields is going to be feeding through that channel rather than kind of what immediately happens to demand as a result of a rise in prices.
Free of Beamish with T.S. Lombard there on the news of the day. If you're just joining, if you're just waking up across the nation, OPEC in Saudi Arabia with their leadership changed the dialogue right now on the data front. West Texas up to 80, Brent crude up to 84. And a lot of study over what all agree is a shock, is a surprise as well. Red and green on the screen right now. Equity's really not reacting lower. Off that news, even Bitcoin up 300. The 10-year, 2-year yield, 2-year 4.09, 10-year 3.51%. Lisa, what's your data observation this morning?
Just the fact that you're seeing a lift in yields on the heels of what we're seeing in the oil sector, the idea that perhaps this will pressure the Fed to go further. You know, this is sort of a contention. David Kelly saying the opposite, that it actually could potentially make them less restrictive because he believes higher oil prices inherently are disinflationary.
What we're going to do right now and what we understand is each and every strategist and economist on oil is different, is take a geopolitical view. Yes, there's Amrita Sen, who's wonderful on the microeconomics of it. Francisco Blanch at Bank of America with a really holistic job. Jeff Curry over at Goldman Sachs. But there is no one, and I mean no one, like Edward Morris, Global Head of Commodities, Citi Research, who has combined academics with the global politics of hydrocarbons. Ed Morris briefs us this morning. Ed, you divide into west of Suez Canal and east of Suez Canal. I want you to talk about the power of this coalition around Saudi Arabia with the Strait of Hormuz and onto the Straits of Malacca and Singapore. What power do they hold?
Well, the power that they hold is an ability to cut and an ability to add oil to the market. And that's pretty incredible because as a group, they have shut-in capacity that's well over 2 million barrels a day. And they're coming off a banner year in terms of revenue generation. That's something they want to keep. And if they want to cut 1 million barrels a day, they've just shown that they have the power to do it.
I literally have on my coffee table at home another firm's analysis to over $100 a barrel, which centers on EM recovery and China recovery. You were brilliant in calling for lower quiescent Brent crude prices. Do you need to reverse this morning and to begin to consider $100 a barrel oil?
Well, we're considering higher prices than we otherwise had. And yes, there is a scenario for $100 barrel oil, but I don't think we're anywhere near that yet. To get to $100 oil, we'd have to have significantly more oil taken out of the market and have a lot of uncertainty based on that oil taken out of the market. That is to say, it would come from a disruption to supply in countries such as Iran, Iraq, Libya, Nigeria, all together at the same time. And we would have no sense, because of the domestic situation in those countries, of when that oil could come back into the market. We have what we consider to be an effort to prevent the repeat of 2008-9, when we had oil prices collapsing from 147 to the low 40s before getting to a normalized level of $90 a barrel. It took about a year and a half to have all of that display work out, given financial flows and given the uncertainties in the market. We have the financial flows now, and we don't have quite that level of uncertainty. We know that supply is definitely coming into the market. I believe strongly that the increase in prices that we've already had is going to place U.S. production on a higher path to growth than we otherwise might have had. And we're thinking that on first blush, looking at everything at the moment overnight, that we're going to have a fairly balanced market, a market that's going to be plus or minus a couple 100,000 barrels a day, no big inventory build, no big inventory draw. And on the demand picture that you were looking at, I have to say we flatly disagree. We think we're in a period of time when we're seeing demand's last hurrah. We're seeing, to be sure, growth in China that's formidable. It basically makes up for the loss of demand growth, demand decline in China a year ago. And we don't think after this increase in demand from China, we're going to see Chinese demand ratcheting up much further. Yes, there is EM growth, and India leads, but that's going to be in the 300,000 or 400,000 barrel a day range, not a 1 million barrel a day range.
Ed, can you frame out then how much of a surprise this cut was, which was unexpected, and comes at a time where some people are speculating that it was politically motivated to send a message to Washington and to possibly boost oil prices, meaning more cuts down the road if it doesn't work?
No, I think it was definitely designed to boost oil prices. Countries were just looking at $60 oil straight on. And yes, they've seen a rally based on a whole bunch of things that they consider to be temporary, not permanent. And yes, they want higher oil prices. The countries that we were looking at, particularly Saudi Arabia, has a significantly higher fiscal break-even than a lot of other countries. And they're more comfortable with oil, certainly with an $80 base and not bad with a $90 base. They didn't see too much in the way of damage to the global economy at $90 a barrel last year. I don't think we're staring in the face of 100. We're certainly flirting with a market which could see more demand in the spring and summer than we otherwise thought might be. But I think the price is going to cap that demand. And we're going to see, we were looking at a world of around 1.4, 1.5 million barrel a day demand. Yes, OPEC was at a higher level than that. And there was some political factor, I think, involved in their own very tight supply-demand balance, even in their last report. This goes against that and says, hey, there's something going on. And I think it's a defense that's going on. They want the higher oil prices. They need it in order to revamp and reinvest in their economies as rapidly as possible. But they have no better interest in $100 oil than most other countries do. They don't want to see a demand decline. They want to prevent the drop of $100 that we saw, or a drop of more than 50% in today's market that they saw in 2008.
But quickly, Ed, just based on what you're saying, if they want higher prices and perhaps $80 is the floor, maybe $90, then what's to stop OPEC Plus from cutting further and further, even as the economy slows?
There are a couple of things that stop it. One is that the economies would slow a lot faster than they're now slowing, and they don't want that to happen. They understand fully well that Chinese growth is not exploding the way people thought it was. You look at the numbers, yes, there was 1 million barrels a day of growth, but that was Chinese New Year, and that always happens. There's nothing about this particular rebound in China that you can get reinforced in your view by what happened. They're really concerned about a drop in oil prices. They just looked at a drop to the 60s, and they're looking back at 2008-9, and I think they made a terrible judgment on that. They think they'll find out that that judgment was terrible, because this is not 2008-9 in multiple ways.
Ed, do you give an okay score to the Biden administration? They seem to be a piñata, even pro, anti-oil, whatever. Everybody's beaten up on our president's energy policy. Are you piling on? Are you beating up on President Biden's energy policy?
Well, yes, certainly. And certainly at the beginning of the administration, there was virtually nobody in the administration that came out of the markets anywhere in the world. They were all people coming from academia, people coming from a very strong pro-environmental, anti-fossil fuel bias, and they didn't really understand markets. They were forced to understand markets. They've gained a lot better understanding of markets. We've just seen a reopening of bids on federal lands. There's legislation that's going to assure that, and they know in the White House that they don't want to see higher gasoline prices, and the way to do that is by having the U.S. be the strong power that it is, as, by the way, now the world's largest gross exporter of oil, at a country where demand has already softened tremendously, where our demand is down well over 1 million barrels a day year on year, and our economy is not in bad shape. So we're seeing a transformation at home, where we've become kind of a critical swing supplier, and Saudi Arabia is very sensitive and aware of that.
Ed, thank you so much for joining us. Edward Morris of Citigroup here on the shock announcement from OPEC Plus, and a combination of the Persian Gulf countries here. It's not just about Saudi Arabia as well. Lisa, to me, the real takeaway there was, I believe Dr. Morris reaffirmed that it will not be Chinese demand, Pacific Rim demand to the rescue. He basically reaffirmed his arch-successful call of last year.
And I think a lot of people are getting on board, because there just isn't the same kind of driver of an acceleration in that economy at a time when unemployment's still pretty high for younger people, and a lot of the consumption is domestically focused. Red
and green on the screen. Futures fractional -2. The VIX churning 19.62. We're looking at Brent crude 84.21. Please stay with us. Pork Garvey was lights out the last time he was on. Pork Garvey of ING. Next.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
The Fed is not thinking pause right now. They're thinking about inflation. They're thinking about a pre-March 8th world.
If they pause, what does the market do in response to that?
The biggest source of policy error right now is for the Fed to worry about what's happening to a couple of bad banks.
We should have some short-term volatility, probably slower economic growth, bad news from the Fed.
I think we're in this environment for some time. There's going to be opportunities.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrell, Lisa Abramowitz, and Tom Keene. A week of non-farm payrolls. We'll have the jobs report on Friday. We've got a stagger to that early in the second quarter with a shock announcement from OPEC Plus on oil. And yes, we just saw with Ed Moore's higher oil prices, Lisa, across West Texas and Brent.
So here is the real underlying question that a lot of people are asking this morning. Are higher oil prices inflationary or disinflationary? Right now, the market suggests inflationary based on the lift that you're seeing in yields. But a lot of people have come on so far say disinflationary because it will reduce demand even further and reduce the amount of discretionary spending people have.
I'll go to Emery to set on this, the microeconomics and the elasticity, the responsiveness that you see in supply and in demand as well. And I find it always interesting that a pro like Dr. Morris always ends up with a demand analysis. He would suggest China and the Pacific Rim are not yet there for $100 a barrel.
A lot of people would agree. So we have a new quarter now. Last quarter, where the narrative started as sort of this disinflationary.
Triple cash worked out last quarter. Thank you for bringing that up, Lisa.
Of potential soft landing, no landing, which quickly came to, are we getting the hard landing with the banking struggles? And now, is oil kind of going to be some of the swing factor that we see heading into the next 3 months?
You know, what's important here, you know, I think we've got to go back as well and look at what we didn't do last quarter is you and I didn't load the boat on Apple. Young Dan Ives was on Friday, and you were begging him on the break, would you just give us a price target change? He had the audacity to lift up his Apple call from a 190 to 205, and it's again on the China. You know, he didn't say China's going to boom, but he said, I'm sorry, China's there to be constructive.
Yeah, and your household is permanently buying a series of AirPods again and again that will definitely lift the potential earnings optimism. Here is the sort of rub with tech, right? Does tech continue to get a boost from rates going lower on the heels of slower growth? Does it basically get a valuation boost and then continue to see demand steady? Or is this going to be something that suffers if we do get a downturn like Mike Wilson thinks?
Everybody out with a readjustment of their year end. John Farrow writing his market outlook always with a March 31 launch. He's on a road show today. He's going, he's in like 3 cities,
Yeah.
I think he's in Denver for lunch. I can't remember as well. Let's do a data check here. We've got a very important guest coming up. A huge acclaim the last time he was on. We need a brief from Lisa as well. Red and green on the screen. The VIX comes in under 20. We begin the second quarter with certainly a resiliency that stunned a lot of the gloom crew here over the last 90 days. Bitcoin over 28,000 confirms that. The yield 4.10% on the 2-year. Breakout above 4.11 would get my attention. We're not there. The 10-year yield 3.52%. As I noted earlier, the real yield comes in 1.18% on the 10-year inflation-adjusted yield, the measurement that I use. And I'd also note an accommodative Bloomberg Financial Conditions Index. Brent crude 84, almost $85 a barrel rounded up as well. You're going to brief us. Are we briefy today?
Well, yeah, 8 a.m. really is the key moment because OPEC Plus has its joint ministerial monitoring committee.
It's going to be
meeting virtually. Perhaps we'll get a signal of what went into this decision to cut production by more than 1 million barrels a day. Halima Croft of RBC had a fantastic note over the weekend saying this move signals that Saudi Arabia will seek to short-circuit further macro sell-offs and that Jay Powell is not the only central banker that matters. Washington and Riyadh simply have different price targets for their key policy initiatives, and that's what we heard from Ed Morris too. They want prices higher, period, full stop.
Yeah, and he said very clearly 2022 was a lesson for not only the Saudis, but also, again, I really want to emphasize here, folks, this is not just Saudi Arabia. United Arab Emirates, in that Youssef Gamal al-Din was reporting from Dubai, there on the collegiality around the Persian Gulf to get this oil price up as well. What else do you have?
8:30 a.m. We hear from St. Louis Fed President Jim Bullard. He'll be speaking to our own Michael McKee.
This is important.
And this is going to be really interesting because what is the reaction function from a Federal Reserve that people are expecting to cut rates in the face of deceleration? They have insight. Is the banking crisis over? Can we move on from that? Okay. How much is credit going to tighten? What is the implication as far as how much that will slow the economy? We'll get all of those fabulous questions and much more, I'm sure, from Michael McKee as he speaks with James Bullard. And today we get some data. To me, this is going to be interesting. We've seen a recession in manufacturing. Does it deepen? We will get that U.S. ISM manufacturing data for March. We'll also get U.S. light vehicle sales. Again, these rolling recessions, and I know that you kind of poo-pooed them last time around when I said it, but different sectors have had very different economic cycles. We have seen that coming out of the pandemic. How does that affect an overall kind of view on inflation, which is so difficult to get to sum the parts?
That's certainly nuanced, to say the least. Let's launch on to a guy that had a huge impact on our show 10 days, 2 weeks ago. We asked Pork Garvey, head of global debt and rate strategy at ING Financial Markets, to come back. And I'll make it clear, folks, your mail, your emails, your tweets to Lisa at 2 a.m., all of that is important on who we put on the show. And there was a primal scream, Pork. Get that guy at ING, get him back on the show. Pork, you are looking at our search for general equilibrium. Let's start with the ugly. How out of whack are we right now?
So thanks for the kind words, Tom, for a start, and it's great to be back. So we've been out of whack for quite some time. I think you go right back to the housing bubble in Japan 3 decades ago, very reminiscent to what we're seeing on a number of occasions over the past couple of decades in Western Europe and the US. And I mean, long story short, that's resulted in the banking crisis and a real ballooning in government debt, which people seem to have forgotten about. We roll on to where we are now, and we seem to be going through a number of mini crises. People aren't talking about debt at all, but we got to remember that debt here in the US is almost 1.5 times the size of the economy. I mean, it's not quite there, but it's heading in that direction. And we're facing into a really difficult cycle period. So, the bigger picture inability to get to an equilibrium is there in the background and will always come back to bite us. But it's being frustrated by these ongoing struggles that we have with respect to monetary policy, getting to a neutral rate and markets getting to where you could define markets as being at an equilibrium. We haven't been there for a long time, Tom.
This dovetails in, folks, to without question my read of the weekend. Adam Tooze is so good on economics. We've seen him many times at Davos. This is Professor Tooze. Is Porrick Garvey talks about how out of kilter we are. We are in the astonishing macro-financial switchback of 2020 to 23. The nominal GDP of debt-ridden Italy is increasing so fast that, well, to Q3 of 2023, its debt to GDP ratio fell year on year by almost 7%. That's a stunning outcome. How we see our financial institutions through this giant $1 trillion rebalancing. Porrick, what time frame do you have to a $1 trillion rebalancing out of the pandemic?
Oh, it's a decades-long process, Tom. I mean, I'm looking at how we got to where we currently are. Look, we had the great financial crisis 15 years ago. We had a pandemic a couple of years ago, and these crises just push us off kilter and make it very difficult to get back to where we need to. I think the key thing for me ahead is, can the Federal Reserve move into a rate-cutting period, and for that to be enough of a cushion to get the economy back on trend, to avoid having to get back down to zero. Now, the call that I have, that we have, is that it won't be necessary for the Fed to go to zero. Our call is that they head down to 3, maybe slightly below 3. That'll be huge. If we can get there for the first time in over 15 years, we would have returned to some semblance of stability in terms of where the bottom for the funds rate is.
Porrick, how has your view for the rest of the year changed for the second quarter versus where it was 3 months ago?
So one of the things that we did know before Silicon Valley Bank went down and we went through the banking angst we've had recently is that lending standards in the US had tightened considerably. And the whole banking angst story really emphasizes the point that things are going to be really tough going forward in terms of ability to get access to credit. And if you look at how that correlates with the unemployment rate and GDP growth, it's only one way. And what it means is, with conviction, the unemployment rate is going to rise, and it's going to rise fast and furious. We don't go to 10%, but we could easily go to 5 or 6%, and the economy is going to go into a recession.
Wow.
And we'll see this panning out over the course of Q2, but more into Q3 this year. Lending standards, the tightening thereof, never gets it wrong. It does push the economy into a recession. Right. It's so important for us here in the U.S.
Porrick, thank you so much. Porrick Garvey of ING, really brilliant there on linking all this together. And Lisa, what's so important there is the ING heritage. They absolutely nailed 9 and 10% unemployment in the last cycle. They James Kingsley and the team there, Knightley rather, excuse me, they led the charge there on a 10% unemployment.
Lending standards never get it wrong, and that's basically what he was saying. You watch the fact that lending standards are tightening pretty dramatically, which is the reason why May 8th is the date that everyone's waiting for to get that senior loan officer survey to understand just how rapidly it is tightening.
I'm biased here on what Adam Tooze said, and you heard it from Porrick Garvey as well, that nominal GDP is a very bright light, and it can be good for corporations where they see more buoyant revenue as well. And it reminds me of the true investment value giant Phil Correa of Pioneer Group, living to, I think he was 103 or 104. And Mr. Correa would always say the bright lights of inflation, and they're on us, which is maybe why the cautious crew got the first quarter so wrong, that inflation helped out corporations.
You're right about nominal GDP and just this idea that inflation can boost the bottom line only until you get some sort of substantial layoff, right? And this is the concern. When you start talking about 5 to 6% unemployment, that's hundreds of thousands of people who are going to be losing their jobs. They aren't going to spend as much. There's going to be less conviction. And that's the concern, that layoffs can lead to layoffs and that it's very difficult to game out and get perfectly right and be surgical with this.
First business day of a second quarter of this most original 2023. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The price of oil jumped today after OPEC Plus announced a surprise production cut of more than 1 million barrels a day. The coalition abandoned previous assurances that it would hold supply steady. Saudi Arabia led the cartel by pledging its own 500,000 barrel a day reduction. The White House calls the cutback ill-advised. The entertainment conglomerate Endeavor has agreed to combine with World Wrestling Entertainment. They'll form a new publicly listed company in a deal valued at more than $21 billion. Now, Endeavor has been pursuing WWE for the past few months. It wants to combine the Wrestling League with its Ultimate Fighting Championship. UBS reportedly will cut its workforce by up to 30% after completing the takeover of Credit Suisse. That's according to a Swiss newspaper. The paper said as many as 11,000 employees will be laid off in Switzerland and another 25,000 worldwide. Meanwhile, Swiss prosecutors are gathering evidence as part of the possible criminal investigation into that deal. The U.S., South Korea, and Japan have begun naval exercises off the Korean peninsula. It's a move certain to anger North Korea, which fired its first missile over Japan when similar drills were held last year. The two-day anti-submarine and rescue maneuvers started today. They include vessels from a U.S. aircraft carrier group. Donald Trump's lawyer says he'll plead not guilty when he appears in court in Manhattan on Tuesday. The former president will also look to have the case dismissed. He was indicted on Thursday, but the exact charges remain sealed. A grand jury was investigating his role in hush money payments made to porn star Stormy Daniels. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
News breaks. No one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of three very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021, and now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
He's there, the kind of upside.
Bloomberg has the Fed coverage you're looking for. Today, an exclusive interview with St. Louis Fed President Jim Bullard.
The benefits of getting inflation under control quickly are vast.
For all your Fed coverage, keep it tuned to Bloomberg.
I have made a decision, and my decision is I'm going to run for president of the United States. I've traveled the country for 6 months. I hear people talk about the leadership of our country, and I'm convinced that people want leaders that appeal to the best of America and not simply appeal to our worst instincts.
Took a quiz here to start the block, and only Anne-Marie Horton got corrected. He is the 46th governor of the state of Arkansas. Asa Hutchinson there, Republican from Arkansas with ABC This Week. and I guess jumping into the ring as well. We're going to digress here. Red and green on the screen. The VIX constructive at an under 20 level. We're watching Brent crude 84.50 rounded up. $85 a barrel, maybe up 6% as well in the OPEC Plus news. Lisa wants to chat that up. But first, we are going to go to our chief indictment correspondent, Amory Horton here. And I do want to get to tomorrow and all that. But if you read the biography of Governor Hutchinson of Arkansas, he's everything the former president can't stand about the Republican Party. How far apart is Hutchinson and Trump?
Well, they're very far apart, but we should also remember the former governor also did support Trump previously when he was running for president. He became very adamant and critical of him when January 6th happened. And now he is saying that this indictment is a distraction. It's not just a distraction for the former president. He's a candidate as well. He's not just a former president. He's a candidate for the Republican Party. He's leading the polls. But it's a distraction for the entire Republican Party and thinks he needs to step aside. But Asa Hutchinson, as well as saying this to ABC News over the weekend, he'll have this formal announcement in April. He's polling at maybe 1%. So this is just becoming it's going to become a much wider race.
Yeah, but the fact is, I saw over the weekend, Anne-Marie, that the former president of the United States has bang-up polls. Am I wrong on that?
He has fantastic polling numbers, and also he has fantastic donation numbers. More than $4 million his campaign says he was able to bring in since the indictment was announced in 24 hours. And more interesting part of those numbers, they say 25% was brand new individuals.
Can he use that to pay his legal bills?
He's using it for his campaign. That's what he's using it for. This is the notice his campaign sent us. I think also interesting, there was a poll over the weekend from ABC and Ipsos that shows that a plurality of Americans think that the former president should have been indicted. It was correct what the Manhattan DA do. But a similar number also think that this is political, and that's what the former president and Republicans writ large are going to be leaning into.
Was that enough indictment talk?
Well, every time that I hear it, I'm just thinking, other than a continuation of the Trump show with people basically, split on both sides of the debate, what have we learned? What's the policy implication? Is there anything, or is this basically just a continuation of the reality television show of his presidency?
Yeah, I think this morning it was called a circus by your very own Greg Valliere, who's on the show a lot. There's going to be no policy implications except for the fact that it's going to be very difficult for leaders to not be asked about this instead of policy questions. So that's kind of that's kind of how I view it.
So then let's get to the policy, because there are a couple of pretty major things that are going on, not least of which is some of the questions about journalistic freedom over in Russia. I'm going to table that for a second. The administration's response to what we saw from OPEC Plus, basically thumbing their nose at the administration, saying, we want prices higher, we don't care if you want them lower. Do they have any ammunition left to really empty their strategic petroleum reserve further, or even engage in any level?
They do, but it'll be difficult because remember, they've depleted it so much in these historic releases over the course of the past year as they wanted to get gasoline prices down. And of course, as Putin has waged war in Ukraine, that we saw a spike in prices. This was their biggest response, making sure they can tap the SPR. So it'll be very difficult for them to do that now, especially as they want to replenish it. We were going towards a level of prices around $70 a barrel that if that was going to be maintained, they could potentially step in and do that. Now what you have is a very difficult position because at some point, this cut from OPEC Plus, including 500,000 barrels from Saudi Arabia, this is going to at some point hit gasoline prices, and that will impact inflation.
Which is really especially problematic because we heard from Energy Secretary Granholm, I believe last week or a couple of weeks ago, that now it's off the table to replenish the SPR because of the price.
Well, you cannot replenish if you are also tapping it. It's one way or the other. If you're going to tap the strategic petroleum reserve and let oil out, or you replenish it, but you're not going to do the same. Have the same at the same time.
Lisa, amateur. Tom Keene, amateur. Even you, with all of your wonderful reporting in Washington, amateur. Ed Morris of Citigroup was just scathing about the lack of market knowledge of the Biden administration. Are they just a bunch of academics down at 1600 Pennsylvania Avenue?
I don't think.
Or does anybody understand there's a bid and ask on Brent?
I don't think that would be fair. There's a huge Department of Energy. Biden has a number of key energy advisors around him, one of them being Amos Hochstein, who joins Bloomberg a lot, who has worked in the energy industry. I think the past year or two has been unprecedented times in the oil market, and obviously, when you're looking at what's going on today, this is because of OPEC Plus's move. And you look at what's going on in Saudi Arabia, so much of this is not just they want higher prices, but also this is a country that's dealing with the collapse of Credit Suisse, which they had a huge stake in.
For those of you worldwide, we are going to digress now. Lisa Abramowitz is going to lead a discussion with Anne-Marie Horton, who has walked the streets of Moscow often.
Well, we heard about this discussion that Blinken had with Anthony Blinken had
Mr.
with
Lavrov,
Sergei Lavrov, saying this is really serious. You cannot take just journalists off the street. And now there's reporting about people being stripped of their visas to keep them in Russia. What is the U.S. administration able to do to really get the Wall Street Journal reporter back to try to loosen the ties at a time when they are hardening and you're seeing the first journalist abduction, basically, going back to the Cold War?
So I think one thing we need to remember, and the Wall Street Journal editor-in-chief was on Face the Nation this weekend and said there's still so many questions that we have. They think where he's being held, but they're not 100% sure. He has not had access, as Evan Gershkovich had not had access to his lawyer. He's a 31-year-old Wall Street Journal reporter. He's an American citizen, and that is why this phone call this weekend was so rare. We do not see Secretary Blinken picking up the phone, speaking to his counterpart, Sergei Lavrov, because of this war that's happening. So clearly, this is key for the U.S. administration and top of mind. We don't know what's going on exactly behind the scenes, but the fact that a phone call was made, very serious, that they want this individual back.
There's sort of a difficult game theory going on where if you negotiate and you pony up some kind of sweetener to get back prisoners, there is an incentive to just get more prisoners. How much are people talking about that in this instance?
People are talking about this because they do think it is a concern that Russia will now just find reasons to go after either more U.S. journalists, that they can get their hands on anyone that the U.S. would deem important and critical they want to get back.
Anne-Marie Horton, thank you so much. Our chief Washington correspondent, of course, very busy with balance of power, looking towards, I believe, tomorrow. We saw earlier in the last hour the former president's private private plane on the runway, I believe, in Florida, and we'll have to see what his travel plans are. What do you call it?
Trump Force One is what he calls it.
He calls it Trump Force One. Okay. Does Pharaoh have the Gulf Stream today? I think so.
Well, you sent him off to about 4 different places in the past 2 hours.
No, he's in Australia for the Grand Prix. It's a long way back. They got to stop to refuel a couple times.
Didn't you also say Detroit on some sort of pitch campaign?
That's scheduled for this week. He's got his March 31 year ahead. It's 9-month year ahead, and he does a road show across America.
That he's writing the March 31st outlook on April 3rd, which is what we all kind of want to do, given the fact that it switches so quickly. Right now, what I am seeing in the market is people perhaps not getting histrionic about this oil move, but nonetheless, kind of framing a new worry out there. I don't think that we can say that it's suddenly changing the narrative, but it's definitely casting a pall over the sort of disinflationary hope that people were having last week.
And the shock you see it in strong Mexican peso. I spent a good part of the morning looking at the oddity of Mexican peso. I'm not used to this number under 18 pesos. It was 21, 22 during Mexican angst of a couple years ago, and we've seen a stronger Mexican peso, 70.9. Some of that's oil influenced as well. We'll have to see what Canada's doing this morning as we move forward. Coming up, this is on the equity market you didn't have the courage to be in. Maybe you need to find a trend, and that is the true expertise of Katie Kaminsky. She's Chief Research Strategist, Alpha Simplex. Really, really enjoyed talking to her. Must watch, must listen for Global Wall Street. This is Bloomberg Surveillance.
the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Surveillance. Good morning, everyone. Jonathan Farrow, Lisa Bramwitz, and Tom Kane. Mr. Farrow on assignment here this morning. The two of us trying to get us open for the second quarter of this year. Red and green on the screen, a churn to the market. Everybody watching. Oil 84 to 68. Let's dash to it. We're somewhat of a truncated data check. Is Lisa Bramwitz looks at big oil?
Well, I want to understand what the read-through is. I mean, everyone's been bullish on big oil, and it hasn't necessarily been lifted, certainly by oil prices.
Q1 was a challenge.
Q1 was a challenge, and a lot of people thought this was going to be the key inflation hedge. Today, perhaps reprising that bet, you're seeing Exxon shares, Chevron shares, and Shell shares all higher by more than 4% on this hope that perhaps OPEC Plus cutting production by more than 1 million barrels will support oil prices over the longer term. I find this interesting. I want to know exactly how elastic this is. If Ed Morse is correct, that perhaps the lack of demand and the dampening of demand will offset this. We'll see how that plays out in some of these stocks. I'm also watching Tesla. And this was a really interesting kind of dynamic. Announcing over the weekend, I missed this. Announcing over the weekend a record quarter of vehicle deliveries, basically saying after they cut their prices by about as much as 20% for the Model Y in rendition, that they sold lots more, they delivered lots more. The shares are lower. Why, right? Down 2.3%. Some saying that they didn't reach Elon Musk's prognostications about how much he was going to put out there, the deliveries that he thought he was going to say. But this, to me, a Jefferies analyst said this that I thought was really interesting. Continued excess production over deliveries will keep the debate going on price elasticity versus general demand weakness. If you have to cut prices in order to generate the same kind of deliveries and sales, what does that mean with respect to margins? What does that mean in terms of the overall outlook for your company?
Absolutely brilliant, and it comes to this word that I use a lot, ambiguity, and that you get the I'm sorry, a price cut is not a free lunch. It's not a immediate path to success, and that's some of the ambiguous trends you see in Tesla.
Well, and although on the flip side, people say, well, he got greedy. A lot of the margins were so big that if you reduce them a little bit, you can generate the revenues. Right now, the market perhaps is saying that some of those hopes are overplayed.
I'm looking at Tesla's 14 new electric vehicles are coming to market, and some of them are from huge small car, lower price players. He's got real competition coming into next year and the year following.
And you're talking about from the U.S. with respect to some of the Detroit big three, but you're also talking about China. And what we're seeing China, from there, that probably is even bigger, bigger competition. That's it. That's all I was looking at today.
That's it? Okay.
There was Micron. We could go further, but those are the ones.
14 stocks.
I can keep going if you want to.
No, I think we can leave it there. Dan Ives with that price target lift on Apple. I guess that's something to talk about here as movers.
Every morning you want me to put Apple in my movers.
Well, who doesn't own it? Let's start with that.
Okay, fine, but it's down less than 0.5%. Okay. It's not the main story of the day.
Well, okay, but to Dan Ives it is. We'll have to leave it there. Red and green on the screen, and right now, this is really important for Global Wall Street, because at Alpha Simplex, they really stay on trend and trend dynamics. And why is this important? Sometimes a trend is your friend, but what's really important here In the last 90 days, a trend has not been your friend. We've been range-bound. We've been collared. The word I use amateurly is soup. We've had lots of technical soup. Katie Kaminsky joins, Chief Research Strategist at Alpha Simplex. Katie, to look back, why was the last 90 days so challenging for those that want to get on a trend?
Yes, I mean, we've had one of the biggest trend environments in years. It was one of the best years for trend that you could imagine. And that was really shorting bonds and also being long commodities in the first half of the year and also long the dollar. A lot of these trends are really focused on the rising rates narrative and Fed policy. As that is shifting, we're actually talking more about consolidation and how much inflation tolerance is going to be the new trend in 2023.
What is the trend for the second quarter and into the rest of the year? What's the identifiable bet you can make?
So I think the one that people will underestimate the most is fixed income. If things are better, if we've actually seen an environment where this banking crisis issue is stabilizing and we're seeing a Fed that's stepping back a little bit, then we're going to see a situation of inflation tolerance. In that case, we're going to start seeing signs that this has to give somewhere. My view is the end of the yield curve. Long-term bonds could still be a short signal this year, and you could also see commodities coming back later in the year as well as inflation continues to be sticky.
This is an important point, Katie, especially because a lot of people are sort of quietly gaming out a greater reluctance to hike rates or even to avoid cutting rates in the face of unemployment that truly is rising. How much do you see that resurgent inflation expectation over the longer term as a result? I mean, what are you gaming out in your head?
Well, I think for us, what's interesting is the technical signals on equities have stayed somewhat positive this year versus last year. You've also seen short signals still hanging around, even though they definitely took a hit in Q1. So I think short bonds, long equities with a little bit of skepticism, but also the potential for resurgence in commodities depending on how equities do, because equities have really been driving how commodities have performed earlier this year, and commodities have been a little bit more taking a backseat compared to equities. Look at the worst performing asset year to date until now, it's crude. There's a good example of a potential change in direction.
Well, yeah, I was going to say, perhaps that changed overnight. I'm wondering how much of a game changer you see the OPEC decision to cut by more than 1 million barrels their production.
So I think the OPEC decision is more like a catalyst on top of something that's already moving the other direction. We saw really a bottoming of oil prices. We also see, as inflation tolerance becomes the narrative, that there's some, tailwinds for energy prices. But you also see the fact that as things look better, there's going to be better demand. So, you're kind of seeing the cuts as something that's kind of accelerated a move recently.
Katie, I've been using recently a lot of the fancy technical stuff that you and Alpha Simplex live on, things that Wells Wilder came up with 30 and 40 years ago. How do you know when to get out of an equity trend? If I throw around phrases like parabolic SAR or ADX DMI and the rest of the mumbo jumbo, folks, they have incense they burn there. They go down to the Charles River in front of the Massachusetts Institute of Technology. They sing Kumbaya. Great. How do I know when to get out of Apple?
Well, I mean, that's the $1 million question. And I think what trend followers we try to do is see some confirmatory evidence that a trend is breaking down. One of the biggest areas to find that is volatility. As volatility spikes, you see that sort of people are uncertain about where things are going. So it's really a function of how much things have moved relative to how uncertain they are, which really determines how much of the trend is still actually profitable or potentially useful.
Well, where's the equity trend right now? I mean, is there any value for Alpha Simplex to look at any of the major indices? I mean, is the NASDAQ 100 storytelling right now?
So we're seeing on average positive signals in equities that sort of have persisted past this recent event. So that's in some sense a suggestion that the market is seeing stabilization in terms of what we just endured in Q1. So I'd say that the outlook is optimistic, but a little bit cautious.
Ask her about the triple leveraged all cash fund.
I heard a birdie in my head, and I'm going to ignore it. No, I'm just kidding. But to me, we are encroaching on the second quarter at a time where a lot of people have been flipping and flopping with all of their narratives. I want to ask everybody this. What has changed for you this quarter from last quarter?
What changed for me is we finally saw a potential bottom in that bear market trend for fixed income. The fact that we actually saw the ramifications of what happened in monetary policy last year, and that the narrative is changing, and that the new narrative is about how much inflation will we tolerate, is what has changed for me this year.
Katie, thank you so much. Greatly appreciated. Katie Kaminsky there, just really, really brilliant with Alpha Simvex. You know, folks, anybody that's watching this show day after day, my deepest sympathies for starts. But, Chris Verone, Katie Kaminsky, these people are on trend. I'm not a big believer in stochastics, jumpy, trying to catch a knife in the dark, buy it here. I'm much more comfortable with the trend base. And to me, and this is important, if I bring up the Bloomberg Total Return Bond Index, it has an equity characteristic to it of bouncing, it didn't bounce off the Ancompora October low. Well, it was like 10 days later, bond prices lifted up, and now it's a huge what if. It's in some ways it's technically elegant, and in other ways maybe I'm, a little nervous here, but she's saying bonds are correlating with that equity lift.
Once upon a time, people thought of credit as sort of the smart asset class that had sort of a tea leaf type of characteristic that could give you a look forward, that was sort of the crystal ball for where equities were going. Now they're trading in tandem, and there really isn't necessarily a greater signal from one than another. Some people would say that credit has performed pretty much bang on in line with equities with respect to what credit spreads are doing, and perhaps it's because corporate balance sheets have been so much better, and they don't have maturities coming anytime soon. So this is the difficulty. How do you follow a trend when the trend is jumping all over the place and nobody can really get a signal versus a noise?
It's real simple. You've got up 20%, whatever. People are talking about an end of the bear market in NASDAQ 100. We'll bring it over to stodgy bonds, bring it over to the land of Bramo, as they say. And I'm sorry, Bloomberg all-in total return is up 8%-ish. Don't quote me on that, folks. I'm doing it in real time here, holding my tang in my hand. But the answer is we're up like 8% in price. Is that a bull market in bonds? Come on, it's 2 years coupon.
Well, this is definitely what some people are saying. You've seen a number of days of pretty steady gains in high-yield bonds even. You're seeing markets kind of maybe start to open up, but the primary market is still kind of rusty. I don't know, you asked a question earlier. You said everybody owns Apple, so you should be focused on Apple every day and really give a sense of where it is. There is a big question facing us in the second quarter hinged to Apple, which is, can we see big tech reassert its leadership over the index the way that it did over the first quarter? Was that simply a departure from the new trend, or is that going to be an example? Heated debate, and it's underpinning a lot of the calls that we hear on the bulls and the bears as they line up heading into the rest of the year.
The other debate here on April 2-3, whatever the date is I'm sorry, the angst of 5 days ago, deposit flow analysis, that seemed to evaporate over the weekend.
The fact that we've gotten 3 straight weekends without a bank failure is a trend. And I think people are basically clinging to that for some sense of optimism, but not unbridled optimism. Because I think that really what we heard from a number of our guests, restraining lending standards, the fact that you're going to get this restraint in credit is going to be an issue. But we're not seeing it really priced in yet. This is really, to me, when do we start to see the true ramifications of that?
Well, we're going to have to see. That's all there is. That's all there is to it. I want to make a program note here. Bloomberg surveillance in its many guises out on YouTube, which is sort of interesting. We're really beginning to build this out as well. It's like my project for 2023. Bramo on YouTube. It's gonna be good. You can see the Bramo channel. Red and green on the screen. S&P -6. This is Bloomberg.
I'll be our first subscriber, keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Well, a surprising move from OPEC Plus as the coalition makes an oil production cut of more than 1 million barrels a day. Oil futures soared following the new inflation risk. Saudi Arabia led the cartel by pledging its own 500,000 barrel a day supply reduction. The White House said the cutbacks were ill-advised. That Chinese spy balloon that floated over the U.S. in February reportedly gathered intelligence from several military sites. According to NBC News, the intelligence that was collected was mostly from electronic signals rather than images. The U.S. shot the balloon down off the coast of South Carolina. The debris that was recovered is still being analyzed. Former Arkansas Governor Asa Hutchinson is re-entering the race for the Republican nomination for president. Hutchinson has been critical of the former President Trump. He told ABC that people want leaders that appeal to the best of America and not simply appeal to the worst instincts. McDonald's is reportedly temporarily closing its U.S. offices this week while it prepares for corporate layoffs. According to the Wall Street Journal, the company told U.S. employees and some international staff to work from home through Wednesday so it can deliver layoff decisions virtually. The cuts are part of a restructuring plan. And in sports, LSU is the new champion of women's college basketball. The Tigers beat Iowa 102-85 to win the NCAA title in Dallas. LSU's Angel Reese had 15 points and 10 rebounds and was named the most outstanding player. It was Coach Kim Mulkey's fourth national title. She won 3 others at Baylor. For Iowa, Caitlin Clark had 30 points. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
Our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Reed World Cup. This is a 3.
As the economic picture does.
Is the OK is getting ready to make this decision.
Is another bank going to fail? Probably not at this point. Is there going to be another hemorrhage? Hopefully not. But is the public going to slow down? Are they going to say, I'm fine with 2 basis points, literally, at my Chase account, and I'll just leave my money there? No, they're not going to do that either. So the flow, I think, away from the low-yielding bank deposits to high-yielding alternatives will continue, and that will continue to pressure banks.
Jim Bianco of Bianco Research joining us in the studio after the Quinnipiac game forum there. I'm not going to mince words. I put out a banner, Elon Musk, what did I say? Elon Musk is something James Bianco. And somebody said, well, why are you doing that? And I said, Jim Bianco is everything Twitter is supposed to be. He has had more impact on Twitter than anyone in this banking crisis I can think of, putting out intelligent, short threads that are thought-provoking. And, he's a guy, Elon Musk should have him out to San Francisco for a cup of coffee.
Did you see that Elon Musk removed New York Times blue check?
No, I didn't see that.
There's been a big debate over how they're going to do this.
Are we going to lose ours?
It's a great question. I don't have any proprietary knowledge over it, but there is an issue that he has where he cut the valuation by half. How do you generate income at a time where you do depend on the Jim Biancos to provide that sort of interesting and valuable content for free?
We've been bank free here this morning. I haven't even looked at the pre-market on FRC. Let me do that quickly before we get to our wonderful guest here. You can do this on the Bloomberg terminal, folks. FRC, well, it's a churning, I'm going to call it 13.94 on First Republic here. And that's, of course, still substantially down. And, you know, you look at a regular chart of FRC and it's flatlining. Maybe that's what American banking is doing.
What, the bank crisis is over? Well, this is the issue, right? If the bank crisis is over, are some of the concerns about tightening lending conditions really over as well, or does that just sort of harden the lines again? Basically, are we changing the narrative, or are we just building on the narrative that people already had faith in?
Do we agree that the recalibrate here at the beginning of the second quarter is a lot of people, including David Kelly at JP Morgan, looking for some real restriction from credit decision making?
Yeah, I think a lot of people are looking for that.
Yeah. Right now, what we're going to do is look at another bank crisis. This is a crisis of the Swiss people with their banks. There used to be 3 big banks, and then SBC bought UBS, but they named it UBS, and there was the upstart Credit Suisse. This is 30, 40 years ago. It's history, and it's a history that Jan Patrick Barnett knows in Frankfurt, who's really been wonderful giving us guidance here. The headline, Jan Patrick, is great. It's not a shock to me. They're going to eliminate 30% of whatever in the merger as well. But give us an update on the outrage of the Swiss people. Can the Swiss people tell the elites what to do?
Well, that's the big question, and we had another headline today that goes into that direction, where you had Swiss prosecutors looking into the deal if there was any wrongdoing on the side of the government officials or Credit Suisse managers or UBS managers or whatsoever. And that tells you a lot, that there's a lot of scrutiny, there's a lot of focus on that deal. I'm not so sure if the wider public, besides the fact that they probably appreciate that there was no breakdown in the financial system again, that they really are on board with that merger going forward. So a lot of focus, a lot of scrutiny, and that leads to that deal. It has very little margin of error.
In a crisis a million years ago, at the beginning of the United States Depression, Jan Patrick, FDR took over, and literally that evening, he and Herbert Hoover put their desks together to begin to solve America's depression problem. What are Credit Suisse and UBS officers doing? Are they putting their desks together in one office? Are they on speaking terms? What are they actually doing on this Monday in Zurich?
Yeah, that's a very good question. And I guess it's kind of friendly, but it's not like that this is a merger of equal, even though Credit Suisse likes to play it down that story that way sometimes. UBS is in the driver's seat here. They are also responsible to make this merger work. So I guess they will tell Credit Suisse employees and managers what is next and what to do. Of course, to make this thing work, you don't want to have enemies on the other side. So you have to somewhat work together and figure out a common ground and say, okay, we have to do this now. We are all in the same boat. We have to make this new bank work in whatever way. And so everybody, the bank managers, the employees, the clients, the public, the politicians, they all need to find some common ground. That will take some time, but it's not an easy one, but I think it's possible.
Execution risk. I was reading about this over the weekend and what that means when it comes to cutting more than 30,000 jobs worldwide, about 30% of the workforce combined of UBS and Credit Suisse. How does this combined entity led by UBS retain the talent that they could be acquiring from Credit Suisse as they announce a round of cuts, and they do have that imbalance that you talk about with UBS leading the charge?
That's going to be a very narrow path that they have to wander along. Of course, they will need some more people for the bigger entity. That's for sure. And if you have talent, and I'm sure there is at Credit Suisse, you want to talk to them and see okay, how can we keep you on board and how can we fit you into the new bigger picture? But overall, it's a very difficult thing to keep everybody happy here, as I said earlier, because it's a mega merger on paper. There's lots of operations. There's lots of risk involved. Lots of people want to have a say in it. Politicians, managers, the people, everyone. And you have not much time. We have the AGM from Credit Suisse tomorrow. UBS is on Wednesday, earnings later this month. So I guess they have to come up with some ideas pretty fast.
How much government involvement is there, Jan Patrick, especially given this investigation, which we don't really understand in terms of what it's looking at?
Well, I guess there's a lot of government involvement, even though they don't tell us this exactly. But there's lots of money that the government put in there. The government orchestrated this deal, so they're kind of responsible for it to work. And you could see it already with the old CEO being now the new CEO, that this was kind of a wish from the government side, that they said, we want to have someone here in charge who can make this work. Because, if this thing goes wrong, in whatever way, I mean, this is the stuff that brings governments down, right? So, and I guess the Swiss top officials know this, and they want to make it work.
Yeah, Patrick, you just nailed the emotion that I have seen since the great financial crisis. And I don't mean to cast aspersion on anybody, including the Swiss government and these two major banks. You said that's the keeping of everyone happy. Since when, under Schumpeterian creative destruction, are we supposed to, quote unquote, keep everyone happy? How did we get here, Jan Patrick?
Well, that is very difficult, and if you put it like that, I would say it's probably also impossible that everybody is really happy. But I mean, it's a merger that was necessary at the end, not for the good reasons, but for the bad ones. So now they have to make it work. And I believe if there are sensible people at work on both sides and with the politicians, and if also the public can appreciate the effort that is now being done, if everybody tones down a little bit the own personal interest for the greater good, that we have a still stable banking system here in Europe, and that the situation of Credit Suisse, which is not 2 weeks old, but 2 years old, is now solved, and hopefully for the better, then I think this can be done. But in the end, it's people, and emotions are high, as always, and you never know. I'm pretty sure this won't be the last Monday that we're talking to each other about Credit Suisse headlines.
Jan Patrick, I'm also thinking about some of the other banks that are swooping in like vultures to attack and get any of the potential talent away from Credit Suisse before the merger really is completed. How much are you hearing about that kind of activity?
Well, not too much. And I think like other banks are more in a wait and see mode at this point, and looking how is this going to play out. This could end up to be a blueprint for Europe as well. Europe has been struggling to really pull off big banking mergers, especially cross-border. This is a domestic one, fair enough. But still, I think like every bank is like looking here and thinking, okay, if this is going to be successful, then this has the potential to change the European banking landscape for good. And then we would probably see more mergers and more consolidation, which is, I guess, good for the system overall, not so good for the job market, I guess.
Jan Patrick, in your afternoon, thank you so much. Jan Patrick Barnett with us here with this real banking knowledge here of working for many European banks before working and leading our coverage at Bloomberg News. I don't know what to make about this other than I take immense issue with you can lay off 30% and keep everyone happy. This whole we are the world, this started, you know, in 2007, 8, 9 as well. Everybody's going to be happy. Baloney. I just don't buy it.
Well, and that's the reason why execution risk means how do you keep the good and get rid of the bad and keep a functional bank without necessarily, completely hammering morale on all sides.
Christiane Lucchese writing for Bloomberg on UBS, the headline, UBS deal to unseat JP Morgan is top Latin America wealth manager. You don't think Fortress Diamond's going to respond to that?
Pretty much you're hearing about it from every single major bank. They are all scouring for
Jamie
talent.
Dimon's going to get on the phone. He's going to call up David Kelly and all the wealth managers. That's what the headline says. And he say, get on the airplane and go to South America.
Absolutely.
That's what's going to happen.
And why wouldn't they go if they're not promised a real trajectory, a real path? It's all moved so quickly. How can they get it together?
It's just amazing. I mean, they're probably going to live on the airplanes and never be home. I mean, there it is, UBS deal to unseat JP Morgan as top Latin American wealth manager. Stay with us. Red and green on the screen. This is Bloomberg. Good morning.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The Fed's process of raising rates so aggressively is having an effect in the real economy.
As long as capital markets are able to keep the money flows coming, we won't have a crashing kind of effect on the U.S. economy.
I do think you have some evidence of slowing in the economy.
We don't think inflation is stabilizing anywhere close to what the Fed cares about, too.
If the economy does take a dive, they'll have to respond to it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
A new quarter, a new narrative. Perhaps we shall see. Oil front and center from New York City for our audience worldwide. Good morning. This is Bloomberg Surveillance. Tom Keene, Jonathan Farrow, Lisa Abramowitz. John Farrow off today. And I do think we've got to focus on oil and question whether this really does change the narrative in a meaningful way heading into this new quarter.
And lifting through the morning here, we've got a solid 85 print on Brent crude right now. The narrative going into the morning is a lift up here as we talked to Ed Morris recently. And I'm sorry, it still comes with all the Persian Gulfness of this OPEC Plus announcement. It still comes back to the demand guesstimate that we all have.
So here's the tension. Is oil disinflationary? Oil prices going higher. Is that disinflationary or inflationary? Do we end up with Riyadh cutting production by 500,000 barrels in the OPEC Plus complex by more than 1 million? Is that going to ultimately cause prices to go higher in the face of demand that is continuing to be sustained? Because we haven't seen a massive drop-off just yet.
Ed Morris divides it between west of Suez and east of Suez. I went with my questioning to him to east of Suez, which is the Hormuz Strait, and then over to the Straits of Malacca off Singapore as well. This announcement, you know, we're in America, we're like, yeah, you know, what's it mean for a gallon of gas? This announcement east of the Suez is a huge deal.
Right now, OPEC Plus is having their meeting, and the fact that they announced this before the meeting was really telling because they were not expected to make any change in output. For them to cut so significantly was really dramatic. At this moment, when you talk about is demand going to decline in tandem with the decline in oil production, that's really also the tension underpinning a lot of the calls. People who believe the consumer has sustained ability to keep spending and then to offset any potential decline that you're seeing with respect to lending and some of these other issues. Right. And those who say the world has changed.
Oh, the world has changed. And, you know, we're going to follow the headlines here this morning in OPEC. Are they in Vienna for this meeting?
It's remote.
It's remote.
It's virtual.
Come on. We got to go to Vienna someday. The three of us there.
That's the real reason why you want it to not be remote, right?
No, but it seems like Vienna's fun. Anne Marie goes, Manus goes. Why don't we ever go to Vienna?
You want to
like an
road
OPEC
trip?
meeting,
Okay.
a road trip.
All right.
It'll be good. What I want to do is get a bond brief here because Tony Rodriguez is coming up. Lisa, help me here. He's writing up spreads here. In the banking crisis, and I guess the sigh of relief over the last 5 days, have high yields bettered? Is it price up, yield down of high yields as compared to full faith and credit?
Yeah, I mean, you've seen some credit spread retracement. You've seen spreads go from as high as almost 5.2 percentage points over benchmark rates down to about 4.5 percentage points over benchmark rates. Still not retracing all of the gains, or at least higher spreads, lower price. Not retracing all of the price losses. Still. Question, does this matter? Because there is a difference between market pricing and the ability to actually get credit. And people are not really selling junk bonds in the market right now. It's not a very open capital market, a little bit around the edges, but not to the same kind of degree.
Let's do a data check right now. Reading, I mean, what do you see, Lisa? I mean, we go to Jobs Day on Friday with some, fairly amount of economic data today. I mean, this week rather. But I don't have much of a data check. As you mentioned, Brent crude was an 84, now $85. 10 cents a barrel, up 6.5%.
I think you're seeing NASDAQ right now. To me, I'm watching this near session lows, down 0.7%. And this, to me, is going to be interesting.
Boom.
Right.
I mean, go up again?
It's very difficult to say anything based on a moment's pricing, especially in this market. But to me, the corollary between suddenly yields higher, tech lower, continues this relationship that really has been called into question by a lot of fundamental investors. Does the fact that we could see higher yields really potentially threaten tech? And on the flip side, lower yields, does that really act as a support of big tech at a time when valuations have already kind of shifted away from Fed policy?
I look at dollar euro. I look at dollar, I look at euro dollar. I look at dollar yen. You triangulate the euro yen, and I'm out strong euro, weak yen, but not through resistance. Again, as we heard from Katie Kaminsky, there's so many things within a band, within a collar right now where you haven't really broken out strong euro, weak yen.
How do you follow a trend in a trendless market?
Exactly. It's very existential of you.
This is a very existential market, especially because a lot of people feel like we're how do you follow a trendless market? How do you follow the trend in a trendless market? Because we really haven't gotten any clarity. And I think that just continues in the soup of, is an OPEC cut in production actually going to lead to even lower oil prices, like Ed Morse was saying, because what you could get is just even further demand destruction.
Let's dive into it now with someone rewriting history after 90 days of 2023. Tony Rodriguez is head of fixed income strategy at Nuveen and joins us this morning. Tony, I want to drill right into your wheelhouse. And to me, one of the hallmarks of the month of March was the United Healthcare gazillion-dollar bond issuance. It was hugely oversubscribed. So investment-grade corporate bonds go down in price, up in yield. The so-called spread widens out. And then what? What is the then what for comfortable investment-grade bonds over the next 90 days?
Well, good morning, Tom. Good to be with you. I think you bring up a good point that what we have seen with this widening in spreads that we saw kind of over the first quarter is that the appetite for high quality, attractive yielding debt is still quite high in the marketplace. Supply, as Lisa had mentioned earlier, has been limited, particularly in the high yield market where it's been very quiet. But even in the investment grade market, while it's open, supply is down from last year. Yet the demand for, again, high income earning assets when the equity markets are clearly, volatile and many view it as relatively risky, the investment grade, high quality yield available is really attractive to investors today.
For example, Lisa, United Healthcare, Dow Jones stock, 11.2% is their weight of debt. Apple, loaded with debt, I say, 5.1% of debt. I mean, that's the idiocy of these hugely profitable companies.
Do they want to take out debt and solidify rates where they are, or do they want to wait for a better entry point? Tony, is your sense that the pipeline is building as companies try to immunize potential borrowing costs even at higher rates?
Yeah, we do think that there's going to be reasonable demand. And that's because while we expect rates to decline somewhat between here and the end of the year, we're not expecting a dramatic move. So really, companies are not going to be waiting for dramatically lower levels. And so when liquidity is available, what companies have learned is certainly to take advantage of that. And we do think that demand is going to be relatively healthy throughout the month of April. And we're expecting supply to recover, given that March saw a little bit of a suppression, obviously, given all of the noise and uncertainty around the financial sector and broader implications.
So you think that right now credit spreads are pricing in the potential weakness that some people are seeing economically that'll come later this year?
Well, we're expecting to see some widening here between now and over the next, call it 1 to 2 quarters, because we're expecting to see some economic weakness as we move into the second half of the year. So our view is that we could retrace to some of the wides that we saw last September. You saw that the investment grade market and the double B market, for example, high yield actually did that. Lower quality didn't quite do it. We've now recovered because obviously the most severe stresses from the financial sector have moderated quite a bit. But we do think you'll see some noise over the next couple of quarters. There could be some better entry points. But largely, we do think investors are being pretty well compensated in the high grade space and in the high quality segments of below investment grade.
And now, folks, it's time for the dumb surveillance question of the day. It's a special feature we have, which I always lead. Tony Rodriguez, do bond markets have bear and bull markets? Like, can I say on price, we've had a bear market in bonds, and then price is going to go up, yield's going to go down, and so that's a bull market in bonds? Do you guys think that way?
Well, certainly they do have bull and bear markets. Our view is that what we're actually going to be seeing here is a range-bound market. So we've seen a nice little rally in the 2-year, for example, from 5% to now just above 4%. Again, we could see some retracement, but we're thinking a fairly range-bound rates market. And by the end of the year, you should see lower yields. So we'll call that a bond mini bull market.
There. Did you hear that reach by Nuveen there?
Yeah, exactly.
Can we quote Rodriguez on that? It's a bond mini bull market. Tony Rodriguez, thank you so much. See how we did that? Equity. Could you see Liz Ann Saunders? It's a bull bond. It's a bull stock mini.
It's a muddle. I think that it's fair for us to say. I mean, that's kind of what we're hearing from everyone. How do you characterize something that's not going to be dreadful? It won't be absolutely amazing, but it will muddle through, and it'll provide some risk and reward and this idea of income at a time when finally it's available.
I mean, the Bramo Cam has caught some of your gloom here this morning, but what's your level of gloom after the 90-day surreal? I mean, let's all agree the first quarter was surreal. I mean, did we think Credit Suisse was not going to be around on April 3rd? I don't think so. I thought it was going to be here.
I'm not sure whether Credit Suisse neatly falls into the whole narrative because they had a lot of issues to start with. It wasn't exactly the deposit mismatch and such of Silicon Valley Bank. You know, I don't know what to make of the first quarter. I'm not sure. I feel that as if we're on a tipping point and everyone keeps saying the economic data isn't reflecting the changes that are being made on the margins in terms of confidence and in terms of some of the weakness. And on the flip side, other people say, well, things still have been coming out good. You actually take a look at the surprise index, and it's the economic surprises have been to the upside. So I don't know what to make of it, to be honest. And I think that nobody else does either, which is the reason why there's been this muddle, this lack of conviction, this mini bull market maybe, and you'll keep getting income.
We're going to be smarter Friday at 8:30. I'm going to go all John Farrow on you right now. ISM, 10 a.m.
Thank you.
Farrow would be all over this. He'd be like lathering up. ISM manufacturing. Prices paid, that'll clearly be important. Looking for a little bit of an ebbing on the survey of ISM. Was that Farrow enough?
That was
do that?
absolute rendition of him.
I think so. ISM, the first good look at the April data. That on the way to the jobs report on Friday. In the 8 o'clock hour, we're in it right now. Coming up, Michael McKee in conversation with the controversial James Bullard of the St. Louis Fed. We'll do that in 15 minutes. Must watch, must listen for Global Wall Street. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The price of oil jumped today after OPEC Plus announced a surprise production cut of more than 1 million barrels a day. The coalition abandoned previous assurances that it would hold supply steady. Saudi Arabia led the cartel by pledging its own 500,000 barrel a day reduction. The White House calls the cutback ill-advised. Entertainment conglomerate Endeavor has agreed to buy World Wrestling Entertainment in a deal worth an enterprise value of about $9.3 billion. The company will be led by Endeavor CEO Ariel Emanuel. Endeavor wants to combine the wrestling league with its Ultimate Fighting Championship. UBS reportedly will cut its workforce by up to 30% after completing the takeover of Credit Suisse. That's according to a Swiss newspaper. The paper said that as many as 11,000 employees will be laid off in Switzerland and another 25,000 worldwide. Meanwhile, Swiss prosecutors are gathering evidence as part of a possible criminal investigation into the deal. And Donald Trump's lawyer says he'll plead not guilty when he appears in court in Manhattan on Tuesday. The former president will also look to have the case dismissed. He was indicted on Thursday, but the exact charges remain sealed. A grand jury was investigating his role in hush money payments made to porn star Stormy Daniels. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg. Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Bloomberg has the Fed coverage you're looking for. Today, an exclusive interview with St. Louis Fed President Jim Bullard.
The benefits of getting inflation under control quickly are vast.
For all your Fed coverage, keep it tuned to Bloomberg.
We're considering higher prices than we otherwise had. And yes, there is a scenario for $100 barrel oil, but I don't think we're anywhere near that yet. To get to $100 oil, we'd have to have significantly more oil taken out of the market and have a lot of uncertainty based on that oil taken out of the market.
Edward Morse, absolutely brilliant this morning from Citigroup. Believe it or not, folks, he was pre-scheduled. Thanks for our team for getting out front of that huge OPEC Plus announcement. We gotta summarize this. John Farrow on assignment right now. Lisa Bramowitz. It's real simple. Here, let's summarize Ed Morse. He's not looking for $100 a barrel, mostly because the demand just isn't there like the demand optimists would suggest.
There are two aspects of this. Demand destruction, which we saw last summer when oil prices got pretty high, and then just declining demand because of a declining economic backdrop. Two different features, and people will disagree over both of them, and you've seen that in the notes this morning.
What we do in surveillance and what we've done for decades is try to get out front of a story and give you some depth on it. We do this at $85 Brent crude up 6.2%. West Texas Intermediate, $69 a barrel for a cup of coffee, now above 80, 80.32 on American West Texas Intermediate. As we talk to Ed Morse about west and east of the Suez, we can look back. I can't believe I'm saying this, folks, but 40 years ago, you had to read Daniel Yergin the Prize, and you had to read Robert Lacey in his iconic one-volume, The Kingdom on Saudi Arabia. All that's been redone and done better by Ellen Wald, senior fellow at the Atlantic Council, in her absolutely definitive one-volume, Saudi Inc. Ellen Wald joins us on short notice this morning. Ellen, you talk in your book about an Arabian dawn. If this is Riyadh and those around the Persian Gulf, is this OPEC Plus announcement a new Arabian dawn?
It very well might be. What we're seeing, I think, is actually an unprecedented level of cooperation. I think I wrote last night that OPEC Plus is now functioning like a well-oiled machine, which we definitely hadn't seen before. I mean, these voluntary cuts were put together quite quickly. I mean, just last week we had ABS come out and say, no, we are sticking with our plans. We've set these production quotas for the next 6 months. So this is what we're sticking with. We see the gyrations in the market as a financial issue and not something that a supply chain could even impact. And now there's basically a complete reversal. I think there's definitely some kind of geopolitical posturing going on here, without a doubt, especially given the comments from Russia's Alexander Novak.
Well, Ellen, in the construct of morning television and radio, you and I are going to do this in 45 seconds. But simply, there are almost tribal rivalries around the Persian Gulf, whether it's Qatar, Saudi Arabia, Bahrain maybe alone, the 5 United Arab Emirates as well. Are they all on the same page, or do they argue unless they bring out an OPEC Plus announcement?
There's definitely always arguments going on, but I do think that we are seeing the Gulf on the same page. It'd be interesting to see really where Iraq is falling in this. It does seem like Iraq really does want to produce and sell more oil, especially now that they've gotten agreement with the KRG in terms of oil exports. So it'll be interesting to see if Iraq really does cut its production, or if it continues to sell despite the OPEC Plus agreement.
What price does Saudi Arabia want for oil?
Great question.
Yeah, that's a great question. I think most people think that they want 80 or slightly above. I think if it gets to 90 or above 90, they start getting jittery about demand, particularly because China is a big customer, and if it's too high for China, they're just going to go buy more Russian oil or more Iranian oil at discounts.
How much do you view this as them trying to boost oil prices versus get ahead a decline in demand that they're already seeing and that they're getting tea leaves from voices over in Beijing?
Yeah, I definitely think that they are very concerned about the potential for a recession to hit oil prices. Think back to 2008. This is kind of that's the touch point that they are going off of. They don't want to see a huge drop kind of fall out of the market and then have to respond to that. They want to get out ahead of it, and so I'm absolutely sure that this cut is in part an attempt to head that off.
How do they mitigate the implication, at least by some, that this is kind of thumbing the nose over of Washington, D.C., which has been trying to go on the other side and lower energy prices?
I'm not sure you can mitigate that statement, because I'm sure that is a bit part of this. There's definitely been rising tensions with the United States. I think that Saudi Arabia has a good point, because its biggest customer now is Asia. It's not the U.S. The U.S. is not in the same position it used to be in terms of the big customer. And I think that Saudi Arabia sees, U.S., if you want to lower energy prices, you produce more oil.
Well, I got like 8 ways to go here. This is where Ed Morse was on east of the Suez. Is there one price for oil, or are we finally gotten to the point, within cents and within the microeconomics west and east of the Suez, there's 2 or 3 different oil prices?
there's 2 or 3 or 5 or 6 or 7, if you really want to parse it out. I do think that while we do see these benchmark numbers, there are all different prices. You've got Saudi Arabia with long-term contracts in China at certain prices. They're selling it at a different price to Europe. They're selling it at a different price to the United States. And that's all part of their calculus now.
Ellen, how much do you view this also as, frankly, running out of capacity to produce, or at least trying to limit how much OPEC Plus produces now to save it for later?
Good point, and I've seen that point raised a bunch of times. I don't see that as a big factor for Saudi Arabia. They've got the capacity. They're coming online with more capacity. In fact, some of that capacity is even spoken for with these new deals with China, where they're going to be supplying another 600,000 barrels of oil a day to joint ventures that they've got in China. So I don't think they are concerned about capacity. I think they are concerned more about prices, and there are definitely other OPEC Plus countries that may be concerned about capacity.
Ellen Wald, thank you so much for the Atlantic Council definitive there on Saudi Inc. This morning. I learned a lot there. That was really informative.
I would agree. There's also this idea that the U.S. doesn't have the same clout with Saudi Arabia that it once did in any way, because they're not the major consumer.
Yeah, I go to the Bloomberg Business Week article. Excuse me, folks. I'm fighting a plague that John gave me. I go over the Bloomberg Business Week cover from, like, I'll say 8 years ago, of all the tankers off Singapore, like 70 boats off at the Straits of Malacca. And we forget that you got to move the stuff. And I've never heard someone say, like Ellen Wald, that all of a sudden, it's not that the U.S. is alone, it's just its own discrete, different story versus coming out of the Persian Gulf. I think Stavridis told us it's 21 miles wide or something, going around India, and then going all the way across whatever that ocean, is that the Indian Ocean there? Am I doing okay?
You're doing great, especially with the arm ocean.
You find a place between Indonesia and Singapore to go through to go up to China and to Japan. It's not a small issue.
You know, Ellen Wald said something a couple of months ago. She said, if you want to get a sense of China's growth trajectory, take a look at the signal from Riyadh. Take a look at what Saudi Arabia does. Their cut, how much does that signal that the tea leaves that they have gotten from China is that growth is not sustainable there and that things are not recovering as quickly? And that really speaks to what a lot of people have been talking about with growth that is going to be disappointing from China, at least versus where people thought perhaps a year ago.
Oh, we're going to have to see on the data here, the first day of the second quarter. Let us start with oil. Lisa, help me here. West Texas Intermediate, 80.30. Brent crude, $85, rounded up, 6% move. I mean, it's not ginormous. It's technically not a big deal. I need 90, 91 before I get technical, but that's a lift.
Yeah, but that certainly was what was giving some sentiment to markets. You're seeing ongoing breakdown in NASDAQ futures at new session lows here, as you are seeing yields higher, down 0.8%. We're going to continue to push this conversation forward on the open. Sri Sankaran of Morgan Stanley, Kathy Jones will be joining us, as well as Charles Schwab and Chris Harvey of Wells Fargo, to bring that conversation forward.
Interesting to see what Harvey has to say. Really, really interesting to see how he's amended his Q2 view.
It's been a tough one to get right, and we're going to be catching up with him shortly.
On radio, on television, stay with us. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
News breaks. No one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of three very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021. And now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority.
Bloomberg Surveillance, and we welcome Global Wall Street and all the rest of you on radio and television to what we're doing here, the first working day of the second quarter of 2023. It has been extraordinary so far this year. It feels like the whole year was in 3 months with the banking crisis and such. But we move forward, and we move forward now in economics, finance, investment. I'm going to get right to it with Jobs Day coming up on Friday, ISM statistics today, all of it coming back down to Federal Reserve policy. And what is so important to understand, and folks, this is out at the Arch of St. Louis on the Mississippi River. It's important when you are a St. Louis Cardinal and you're on injured reserve. So Adam Wainwright of the St. Louis Cardinals saying the Star-Spangled Banner on opening day for the Cardinals, which clearly sets us up for next year. On opening day, Michael McKee, we expect James Bullard of the St. Louis Fed to sing opening day for the Cardinals.
Well, I suppose I could make that my first question, Tom, to Jim Bullard. He is the president of the St. Louis Fed, and he joins us now. Good morning, Jim. Good morning. Tom wants to know if you're going to sing the national anthem on opening day next year.
I have no plans to do that.
Well, as Roseanne Rosenadana used to say on Saturday Night Live, it's always something. We were in the middle of a quote-unquote banking crisis, and now we've got another oil shock this morning. Everybody waking up to headlines that say maybe we go to $100. So as a Fed official, when you see that, how are you reacting?
Well, on the financial stress, I think, this is a post-Dodd-Frank world, and I do think that the reaction to the banking problems was swift and was appropriate, and both here in the U.S. and overseas. And so I think, the idea that there are macro-prudential tools that you can use in that kind of situation to calm things down, that seems to have worked so far. You never know if there's further things happening, but if there are, we can react with macro-prudential tools again. And then on the monetary policy side, we can still proceed to fight inflation and get inflation down during 2023 and 2024 back to target. So I think, this idea that you can walk and chew gum at the same time, you've got the macro-prudential tools for financial stress, and you've got monetary policy to fight inflation, and we can do both as long as the financial stress doesn't morph into something much larger. And so far, so good, but knock on wood, you're never sure what's going to be around the corner.
But does $100 oil, or the idea at least of this oil shock, complicate your job?
Yeah, well, of course, oil's always, the oil price is always important. I would have expected somewhat higher oil prices anyway, with China coming back sooner than expected during the first half here of 2023, and with Europe skirting recession. So both of those, and strong data in the U.S., all of those are pretty bullish factors, I would say, for the oil market. This was a surprise, the OPEC decision, but whether it will have a lasting impact, I think, is an open question.
Now, you had already moved up your estimate of where the Fed funds rate needed to be to bring down inflation. You were talking an effective rate of around 5.6%. Does this change that calculation at all? And can you explain why you think we need to go that high to hit the terminal rate?
I think we'll need to get over 5%. The committee says that the median person on the committee says a little over 5%. I'm a little higher than that. I think inflation will be stickier, and I'd look mostly at the core measures of inflation like PCE, core inflation, or the Dallas Fed trim mean, which really hasn't come down very much at all. It's still in the 4% range, so 4.6 or something like that. So we're still talking about a lot of inflation, more than double our inflation target on that basis. And oil prices fluctuate around. It's hard to track exactly. Some of that might feed into inflation and make our job a little bit more difficult.
Just north of us this morning in Oak Brook, Illinois, McDonald's has told its corporate officials to stay home this week because they're going to start notifying people that they're being laid off. How concerned are you with all these headlines about layoffs coming in that you may go too far?
Yeah, the labor market is super strong. Still many more job openings than there are unemployed workers. I think if a worker does get disrupted today, that they should, let's hope and pray for them that they'll be able to get a new job. But it's still a very robust labor market with 3.8% unemployment. The Kansas City Fed's labor market conditions index still at a super high level. Jobs reports have been very, very strong in 2023 here. So you're really not seeing much ebbing in the labor market. I think there's structural issues where labor supply is running under labor demand, and that's going to take quite a while to settle down.
What are you expecting for Friday, for the jobs report?
I don't have a number for you, but anecdotal information seems to indicate that the firms are still scrambling for workers. They're doing some other things that are strategies that might slow this down a little bit. They're substituting capital for labor. That makes a lot of sense in this situation. But I just think that on the whole, they still need workers.
Well, if they still need workers and supply is running below demand, that has to complicate the idea of monetary policy, because that's not what's supposed to happen when you're raising rates as much as you have.
That's true, although I'm not as oriented toward the Phillips curve as many, but I think the way I would state it is that the strong labor market gives us headroom to fight inflation. It's a good time to be fighting inflation and trying to get inflation back to target while the labor market is as strong as it is. And even workers that get disrupted, hopefully will be able to find a new job and maybe a better job in this situation.
You have critics around the country and certainly on Capitol Hill that say workers are finally getting their share. Wages are going up, not quite keeping up with inflation, but much better than they had been. And here comes the Fed, wants to squash them down again and cut the wage increases in order to bring down inflation. What do you say to those people?
Well, what are they talking about? Real wages have gone down for most people, so the inflation is hurting them. So inflation is hurting the average worker.
So you don't think the Fed has a perception problem with America these days?
You'd like to get rid of the inflation so that people can get there, get a better labor market outcome and be able to afford the goods that they have to purchase. So I think there's been a lot of confusion around this issue. It's true that some workers in some categories got more than the increase in wages that more than made up for inflation. But for many workers, that hasn't been the case. They've been lagging behind in real wages, and that's why you'd like to bring inflation under control and get a better outcome for the labor market.
Markets have been struggling this morning to figure out what's going to happen going forward with the oil price headlines. But going into this weekend, they were pricing 4 rate cuts over the coming year. Why are you and Wall Street so far apart in what you say is likely to happen?
They should listen to me. Here's what I think. I think I put 80% probability that the financial stress will decline, and then make that your baseline forecast. I think that's for low growth, but growth, a continued pretty strong labor market, and inflation coming down. That's got 80% probability. Maybe now I'd go to 85% probability or something. And then the other branch where financial stress gets worse, then we'll have to bring out more macroprudential tools, and it'll be a stressful situation, and all bets are off in that situation. The problem with Wall Street is they've got too much probability on that branch and not enough probability on the other branch. So I think they're going to reprice to the slow growth scenario, and so I think we'll see this change in the weeks ahead here.
Go back to the banks for a second. In February, the staff at the Open Market Committee presented on the idea of these asset mismatches on bank balance sheets. So you were kind of aware that this could be a problem. Was there something that the Fed missed or didn't do or should have done to keep these the bank situation, we'll call it, from developing as it has?
I can't talk about what was presented at the FOMC meeting. So I will neither confirm nor deny that. But my own staff here was certainly well aware of issues with banks. We talk to bankers all the time. We're a regulator of banks, and so we knew that there were issues about, let's say, some deposits running off to non-bank entities that wanted to pay a higher rate. That's occurring, but I think at a rate that's certainly manageable for at least for the banks that we talk to. They've got some securities holdings that have lost value as interest rates have gone up, but that also I think is manageable for nearly all institutions. So that they're running businesses and they've got challenges, but they're also competitive, and they figure out ways to manage the situation. I would also say anecdotally that most banks say loan demand is strong, and they actually have incentives to make loans at the higher interest rates if they can, in order to offset some of the older loans that they have that are at lower interest rates.
Well, we got to send it back to Tom, but given how Tom introduced us, you've got predictions for interest rates, growth, GDP, the end of the year. Cardinals prediction?
I'm sure it'll be a great year for the Cardinals. I think they'll win the division, and they'll do very well. Another victory yesterday, so excellent.
All right, Tom Keene, we'll send it back to you and the folks in New York. Given the fact that Jim Bullard is so optimistic about the Cardinals, we'll take that as a good sign for the economy. We hope.
And we like the pitcher's clock as well. Michael McKee, thank you so much. We're getting back to National League Baseball here. James Bullard of the Fed. Our John Gittleson and Dawn Lim report here, an update on the Blackstone Real Estate Income Trust. And they're talking about the liquidity, the redemptions as well that we're seeing. And to put this in scale, this trust was up 8% last year. I want to make clear, even with the withdrawal requests they're seeing some rent stability within the Blackstone Real Estate Income Trust. Stay with us. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. A surprising move from OPEC Plus as the coalition makes an oil production cut of more than 1 million barrels a day. Oil futures soared following the new inflation risk. Saudi Arabia led the cartel by pledging its own 500,000 barrel a day supply reduction. The White House said the cutbacks were ill-advised. That Chinese spy balloon that floated over the U.S. in February reportedly gathered intelligence from several military sites. According to NBC News, the intelligence that was collected mostly from electronic signals rather than images. The U.S. shot the balloon down off the coast of South Carolina. The debris that was recovered is still being analyzed. Extra Space Storage has agreed to buy Life Storage for $12.4 billion in an all-stock deal. And Life Storage operates more than 1,100 self-storage properties. Self-storage real estate benefited during the pandemic because people wanted more space while working from home, but demand and pricing power have begun to soften. And Bed Bath & Beyond has begun a 3-week countdown to possible bankruptcy. The home goods retailer is trying to get another $300 million from equity markets that have largely turned against it. Shares plunged 50% after the company raised $360 million from a hedge fund. The deal diluted existing shareholders. An entertainment conglomerate, Endeavor, has agreed to buy World Wrestling Entertainment in a deal worth an enterprise value of $9.3 billion. The company will be led by Endeavor CEO Ariel Emanuel. Endeavor wants to combine the wrestling league with its Ultimate Fighting Championship. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
We do think that credit conditions are going to tighten. At this point, it's difficult to gauge. If that does tighten, I think it certainly means hard landing is more likely than even we were anticipating. Our view is still that this is a moderate recession. It looks a lot like the early 1990s. We've always thought it happens in the second half of this year and haven't really changed that view. I think it's consistent with what we're seeing.
Just brilliant on Friday. Matthew Lozzetti joining us, chief U.S. economist of Deutsche Bank, and arguably for me in market economics, the call of 2022 that came out and said recession, but they were heated when they had the courage to make that early call that it would be delayed. And a lot of other people got on the gloom bandwagon. And Deutsche Bank, in hindsight, looks really, really sharp about saying we're not there yet to some form of economic slowdown. We welcome all of you on Bloomberg Surveillance. John Farrell on an assignment coming back from the Australian Grand Prix, and Lisa Bramowitz getting ready for the 9 o'clock hour as well. Red and green on the screen. I've got, I don't know what to make of it. NASDAQ pulls back a little here. First day of trading, the VIX 19.64. Two-year yield gets out. What's elevated now? I stand corrected up 10 basis points, 4.12%. Getting out front of key ISM data at 10 a.m. Please stay with us on radio and television. That'll be the first good data of the month. I never follow it, but Farrow tells me it's an actual big deal. Right now, the big deal is to speak with John Riding. He's a chief economic advisor at Breen Capital, and there's any number of ways to go here. John, I want to talk with James Bullard of St. Louis. I'm going to say you have been in the camp with Bullard looking for some form of not sustained inflation, but the inflation worry it won't go away. Bullard making clear we're putting too much focus on the banking crisis and not enough on monetary policy 101. Do you agree?
I do agree. I think it's very important to, realize that the U.S. is a very strong capital markets and banking system, and it's a very different situation than back in 2007, 2008, and the financial crisis that took down Bear Stearns, Lehman Brothers, AIG. It's a very different world. So I think there is too much focus on that. The responses have been very swift, very strong. We can argue what the origins of this is, but we do know that in effect, there's an implicit guarantee of all deposits, regardless of deposit insurance. There's some reform that needs to be considered later, but that was essentially what Powell promised at the last FOMC press conference.
We're going to rip up the script here with John Riding, who lived the Bear Stearns crisis. I would say one of the great themes right now, John, is that James Dimon standing out front of your Bear Stearns headquarters on that tumultuous day, his hindsight is he made a massive mistake. Are we repeating the foibles of Bear Stearns and Lehman Brothers, or have we learned our lessons over 15 years?
Well, I think we've learned some lessons. There's no doubt about it that the higher capital levels, the stress tests have done a lot to strengthen the underlying banking system. But you have to have significant questions about how that was implemented by supervisors, because if you look at the case of Silicon Valley Bank, they had over $15 billion of losses in their held-to-maturity portfolio, which doesn't get run through the P&L statement, doesn't get scored against their capital. So they had almost all of their capital, the size of their capital was almost the same magnitude as the size of their losses in the held-to-maturity portfolio. Now, you can only hold something to maturity if you have the funding to hold things to maturity. And that's where there is a similarity to 2008, which, and in many ways, what happened there was so much faster. But we know how to fix bank runs. Deposit insurance fixes bank runs, and we've had that, and we've had some stabilization in the situation there. And the banking system as a whole looks very different in terms of the size of their held-to-maturity losses against their overall capital.
I want to get back on script here because the time is so important. Folks, if we're just joining us on radio, John Riding of Breen Capital with us this morning. And John, I've got to dovetail two themes this weekend. One was Adam Tooze's phenomenal essay in the FT alluding to the delusion or the imagery, the illusion that nominal GDP gives us. You've written about this for years, and I pull it over to Dominic Constam, ex-Credit Suisse, now at Mizuho, and the idea of we've got an odd nominal GDP because inflation is set high. We have a certain form of restriction, and then the Constam's phrase, are we super restrictive right now? All the dynamics that are going on, does Powell have a restriction he didn't expect?
Well, let's start with one definition of restrictive, which is, do we have restrictive monetary policy? And I don't think that the Fed's seeking that sufficiently restrictive level of policy. I don't think they're there yet. I mean, Jim
Bullard made clear,
rightly pointed out that the underlying inflation rate is in the 4s. And he cited the Dallas Fed or all the other measures. They're pretty firmly in the mid 4%, which means that interest rates, the policy rate adjusted for inflation, has only barely turned positive. Now, there is the question, how much does a credit tightening have an impact here? And does that substitute for additional rate hikes? But Jim also said that loan demand has been strong. So, we have to see how that plays out. But when I said the U.S. is these twin markets where if the banking system has issues, there's still the capital markets. In many ways, this is the reverse of the long-term capital episode back in 1998, where the capital markets froze up and the banking system was there to lend. So we do have to remember that there are big banks as well as small banks. The big banks will get bigger out of this as they did out of the last financial crisis. There'll be I think, willing to lend, willing to take market share. And then there's also the capital market. So let's look at things like the NFIB survey and see if the availability of credit becomes a constraining issue on businesses. It hasn't been up until this point a major concern for them.
We don't have to turn this into a history lesson. Steve Leisman with a great essay. He's over at the Death Star. Steve Leisman with a great essay years ago on neo-Vixelian theory. And we don't need to go back to 1910, 1920 theory. But what we have here is a whole body of people, John, who've never lived in a normalized interest rate environment. Should look, we're going to get out to the oddity of a normal rate environment. What's it going to be like?
You know, it's very funny referring to Steve Leisman's essay because that came out of a conversation that I had with Steve, and we were talking about Vixel before it became popularized, this concept of a natural rate of interest. Now, the Fed has argued, coming out of work from John Williams for a long time, that natural rate of interest has been depressed and became very low.
Olivier Blanchard says that, yeah.
Secular stagnation. Yet if you look now in the markets are saying real interest rates are going to be positive at a significant level for the next decade. We got as high as 1.7%. That was maybe a bit high. We were around 1.25% at the end of last week. So if you have a real rate of 1.25% and you got to get inflation down, but right now you're talking inflation running at underlying terms at 4.5%. Where does that long-term rate of interest belong? Right now, the Fed still...
Where does it belong? We're going to run out of time, and this is critical. Ken Rogoff's in the camp with you versus what Olivier's saying. We're going to talk to Olivier Blanchard at the IMF meetings here in 10 days or so. With that said, where is your new 2% level? Does it have to be elevated higher, as Adam Posen says?
Well, I think the Fed has to raise its long-term neutral rate of interest from 0.5% adjusted for inflation to something more like 1.25%. It's where the markets are. I would say that as a long-term interest rate, allowing for inflation uncertainty, probably should be thinking 4%.
You're at 4%?
Anchor for the 10-year. And probably for the funds rate going forward. This idea that 2.5% is our long-run neutral rate of interest, I think it is an outdated concept.
Okay, John Writing with us today. Really spirited conversation. There's just a window over the fun we're going to have over the next 2 weeks. John, Lisa, and I. John Writing is with Breen Capital. This morning, coming up on Bloomberg Television at 10:30, Amrita Sen, I'm going to tune into this. This is going to be important. Amrita Sen here on the OPEC Plus announcement, the dynamics that you saw. Thanks to our team working all day Sunday and into today to work on that OPEC Plus story. Red and green on the screen, SPX down 5. Stay with us. This is Bloomberg.
Studios in New York and San Francisco. Our new hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television.
Chris, can I ask my landlord for a rent cut in the next couple months? Like, is that reasonable?
Well, I guess it depends when you signed your lease, Joe. It sounds like you got kind of one of those pandemic deals that, particularly in New York City, where rents actually fell really sharply in that first year of the pandemic. So we are really seeing the market having turned a corner a little bit over these past few months. Prices have been coming down for 4 straight months now in our national rent index.
Wow.
But, if you're still paying that late 2020 level, then you might not necessarily be eligible for a discount at this point.
Good point. All right, I have another question, which is like, so I have 2 kids, but unlike other people, I actually am cool, and I don't want to move to the suburbs. Like, I want
This episode is just Joe taking like advice on handling his rent.
I just want to point out, I really like my landlord.
You love your landlord?
She's very attentive. We have a very good relationship. So even though I started the episode saying I was anxious, if she is listening to this, I hope she hears that I really enjoy where we live, and I really enjoy our the landlord.
She should factor your consistency into her pricing algorithm.
We've never been. Yes, exactly.
Excellent.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. Starting 2Q with a softer tone, the NASDAQ down about 0.7% ahead of the open. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Farrow.
OPEC's surprise production cut fueling inflation concerns, sending Treasury yields higher and big tech stocks lower as layoffs continue, with UBS said to be joining the list. We begin with the big issue, Q2 getting underway.
This is sort of the start of a new quarter.
This year has all been about the whipsaw.
The volatility that we saw in 2-year yields.
2-year yields went from 5 to 4, and 10-year yields went from 4 to 3.5. It's whiplash.
I think the market is telling you that investors are starting to, exhale a bit.
We've had a series now of problems.
3 banks having been shut in the U.S.
Not only do you have the banking crisis that's weighing on confidence.
When you think about the Fed and all of these, they've still got a big inflation problem.
These crises just push us off kilter and make it very difficult to get back to where we need to.
We need to wait and see that.
The outlook is optimistic, but a little bit cautious.
I'd rather be a little late to the party than get there early and not have anything there.
Joining us now, Morgan Stanley's Sri Sankaran and Kathy Jones of Charles Schwab. This has been the big question. Here we are embarking on another quarter. Kathy, what has gotten clear in the past 3 months?
Very little, other than I think that the Fed has still continued to ratchet up rates despite problems in the banking center. So I think that the only clarity we have is that the reaction function remains pretty strong, and it's going to take a lot for them not to hike rates again in May. That being the case, we think that will be the end of the cycle in terms of the peak in rates. But I think what we have seen is that the Fed is still really focused on inflation, even at the expense of slowing growth and the problems in the banking system.
Sri, from your vantage point, what has changed with your Q2 outlook from Q1 in terms of your baseline, in terms of your main assumptions?
Yeah, I would say a couple of things which we're watching closely when we're looking at how Q2 could differ from Q1. One is the transition from inflation and rates volatility to the concerns around growth. I think that pass-through or transition has become kind of more imminent, so to speak, as we progress. And the second aspect of it is that the Fed was doing the heavy lifting with respect to the rate hikes and tightening of financial conditions. But what's changed over the past month, which translates into what the outlook for Q2 is going to be, is about credit markets and bank lending. That's what we're going to watch in terms of the tightening of credit conditions as we go ahead.
We're going to build on that coming up. In the meantime, Kathy was mentioning the Fed, which has another hike in the pipeline. That's the take as well, not only from Kathy, but also St. Louis Fed President Jim Bullard. Bloomberg's Michael McKee caught up with him in an exclusive interview just moments ago. Take a listen.
The median person on the committee says a little over 5%. I'm a little higher than that. I think inflation will be stickier. You're really not seeing much ebbing in the labor market, and oil prices fluctuate around. It's hard to track exactly. Some of that might feed into inflation and make our job a little bit more difficult.
Mike joins us now, and Mike, we did hear Jim Bullard say the market should be listening to me. He has a different view than some in the market.
Yes, he thinks that inflation is going to be stickier than many of his colleagues do. And he's also worried about what might happen with the economy and inflation, wages and inflation, because the labor market is still so tight. So he suggests that, as you pointed out, the market's listened to him, and he's at 5.6%, which would require another 3 moves by the Fed to get to what Jim Bullard thinks is restrictive. But he did admit there's a lot of uncertainty out there, and there's no reason to make a decision if you're the Fed until you get right up to the next meeting, which is May 3rd.
Which is the reason why a lot of people are pricing them out pretty much, and even rate cuts. Michael McKee, wonderful work. Thank you so much for that interview. Sri Sankaran and Kathy Jones still with us. Sri, given the fact that you're looking at tightening and lending standards, could the Fed raise rates 1, 2, even 3 more times this year?
Our house call is for potentially 1 more rate hike, and then again, the June hike is probably a question mark. We're not kind of basing that. We're not including that in our base case. But at the end of the day, I think some of the comments that Chair Powell made during the last press conference do suggest that they are cognizant of the fact that the change in funding conditions for banks, specifically the regional banks, which are important in the context of lending to certain asset classes like commercial real estate and C&I, that does mean that some of the hikes which the Fed would have otherwise considered may be kind of transmitted through by the markets and the tightening of bank lending conditions and credit conditions rather than the Fed doing the work there.
Kathy, do we have any indication of this sort of expected tightening in lending that will offset the need for a greater degree of rate hikes?
Well, we've already seen, as you've referred to many times, that senior lending officers survey that was tightening in lending standards even before the problems developed with the regional banks. I would expect that will continue. We've seen, the high yield market kind of closed up for a couple of weeks. Now it seems to be coming back, but there really wasn't much activity there during that whole disruption in the banking sector. So I do think we're seeing lending standards tighten. I do think that, and particularly in some of the smaller business loan categories, that will probably see banks get more cautious about it. So I think we're seeing it. It's just not filtering through in a big way yet to slowing growth enough to get inflation where the Fed wants it to be.
Kathy, does that change your view at all in order to basically get to that lower inflation? Does that make you think that we need higher rates for longer?
No, we don't. So our view is 1 more rate hike. The Fed's plan, as they've laid it out, is to hold for the rest of the year. We think that that's pretty optimistic on their part. I do think at least 1 rate cut before the end of the year in 2023 and some more into 2024. So we're seeing slowing growth. We're seeing ebbing inflation. We're seeing wage growth slow down. And I think that and now tightening financial conditions, all that adds up to a slower economy in the second half and the likelihood that the Fed will probably have to ease somewhere down the road.
And this whole idea of disinflation was really fueled by much lower energy prices until the weekend when OPEC Plus delivered a surprise production cut, slashing supply by more than 1 million barrels a day and reviving the case, at least to some, for triple-digit crude. Joining us now, Bloomberg's Julian Lee from London. Julian, how significant and how unusual was the production cut that we got yesterday?
It was unusual. I mean, it was unusual largely because of the way in which it was done, which was without any meeting, without any real forewarning. There'd been talk back in late January, early February, around the time that the group's monitoring committee last met, that there might be an output cut coming, and it didn't happen. So this is clearly something that's been kicking around within the OPEC Plus group for a couple of months. Nonetheless, all the guidance leading up to the meeting that actually took place earlier today was that OPEC would hold steady, or the OPEC Plus group would hold steady. So this has come as a surprise to the market.
And a lot of people are seeing this as a potential for upward surprises to the price of oil. Julie and Leah, thank you so much for all your reporting, and I'm sure it will continue throughout the day and weeks to come. Sri Sankaran and Kathy Jones still with us. Sri, from your vantage point, how much does this potential cut, or 1 million barrels that the OPEC Plus group is going to be executing, how much does that change the narrative for you?
I mean, in the very near term, obviously, it does add to some of the inflation pressures or uncertainty around the Fed response function. But I would say that over the medium term, it does feel like this has a flavor of a potential OPEC put of sorts, in the sense that they're trying to get ahead of more recession fears being baked in by the market. So it does set a bit more of a floor to prices rather than translate into a much more bullish signal over the medium term. But our kind of house call has been, from Martin Ratz and team, our oil strategist, has been much more close to the kind of the mid to high 90s is what we're calling for into year end. And this was before the OPEC cut. So clearly some of the downside risks to the forecast were building before the recent announcement. And I would say that that takes away some of the downside risks rather than create much more upside. But I mean, obviously, these are very recent developments. So we will be continuing to watch the price action as we go through the day and the weeks.
Sri, when you take a look at this from a credit perspective, are higher oil prices disinflationary or inflationary?
That's a good one. I would say that, I mean, holding ranges at these levels is probably a good thing for credit, because there were two specific sectors of the market that credit investors were most, let's say, constructive on or overweight on going into this year. One was financials, the other was energy. Clearly, the confidence in the financial sector was shaken a little bit by the developments of March. And some of the risk to the downside, which we're building with respect to energy, that would have translated into more negative price action for the other big sector overweight for the credit investors. So to some extent, I would say that the recent developments is probably going to kind of improve the outlook for some of the pockets of the credit market that investors are overweight. But clearly, we don't want to see too much of this shock, because then the macro side of the signal starts to matter much more. Right now, it's a micro positive, macro question mark.
Kathy, from your vantage point, how do you view oil as a signal of whether it's inflationary, disinflationary, or neutral?
Yeah, I mean, I think that obviously top line inflation picks up when we see oil prices go up, but we're really focused more on the core. And I would say at this stage of the game that it's more probably long-term disinflationary. So OPEC Plus wouldn't have done this if demand had been strong. So clearly demand is already too soft, and the fear is that it softens further in the global economy because of all the rate hikes and the cumulative impact of central bank tightening. So I'm not sure that it's anything more than a signal of concerns about slowing global economic growth. But I think domestically, when we look at it, we're already seeing an overburdened consumer to some extent, with very high credit card rates, high loan rates on autos. We're starting to see some pickup there in default rates. So I think it's more disinflationary because it simply takes money out of the pocket of consumers that might have been spent elsewhere in the economy.
Kathy, you said that we're already seeing spending drop off, and I know that peripheral Citigroup, for example, Bank of America credit card surveys are highlighting a little bit of this on the edges. How much can you make of that? I mean, is this truly the sort of disinflationary force that people have been waiting for?
Well, I think it's more of a return to the mean. You know, we've had very strong nominal spending in the economy now ever since we came out of the pandemic. And what it may be, what we are picking up, the signals are that it is slowing down, both in nominal and real terms. So I think that that's worthwhile keeping an eye on. You know, when we looked at those fourth quarter GDP numbers, we saw real consumption start to fall off. So I think that ends up being more of a disinflationary story in the second half of the year than currently with the jump in oil prices.
Sri, your view on how consumer spending is evolving currently and likely to?
Yeah, I mean, I would agree with some of the points that Kathy made there, right? So the medium term, it does add to some of the changes in consumption patterns specifically. Our econ team, Ellen Zentner and team have been talking about the potential mix shift in terms of consumer patterns, i.e. kind of reducing, not specifically reducing spend, but effectively shifting away from discretionary and services-oriented spend to non-discretionary sort of spend. So that effectively is what we're watching out in terms of the consumer patterns. It's not like a massive shock to the consumer just yet, but it does kind of accelerate some of this mix shift effects that we've been focused on.
Sri Sankaran, Kathy Jones, both of you are staying with us. Coming up, more layoffs underway.
The Federal Reserve is themselves. Their unemployment forecast suggests that we're going to get some negative payrolls, perhaps losing 300,000-400,000 jobs between March and the end of the year. So, yeah, I think that's likely.
McDonald's and UBS said to be the latest to plan more job cuts. That conversation coming up next.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of pre-work before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
We're going to get some negative payrolls, perhaps losing 300,000-400,000 jobs between March and the end of the year. So, yeah, I think that's likely. We can see this coming. We've got the credit tightening that's going to be particularly affecting the small business sector, and that is going to slow the economy. And we can see it all over the place.
Companies around the world continuing to tighten their belt with more job cuts in the pipeline. McDonald's becoming the latest to make a move. The Wall Street Journal reporting that the fast food giant is sending staff home to deliver layoffs virtually. And across the Atlantic, UBS looking to slash its workforce by up to 30% after the Credit Suisse takeover. A Swiss newspaper reporting that it could mean as many as 36,000 cuts worldwide. For more, joining us now is Bloomberg's Shonali Basak, as well as Abigail Doolittle in New York. Shonali, I want to start with you. With UBS, what have we learned about where these job cuts are going to focus?
Listen, Lisa, we know that when it comes to mergers and acquisition, a key tenet is synergies, which means job cuts come underway for roles that have duplications. Remember, Credit Suisse did not have a huge U.S. wealth manager, but these two companies have humongous wealth managers worldwide. UBS will be looking to retain the best of the best, while you have Deutsche Bank, Citigroup, JP Morgan, certain banks planning to pause their hiring pauses here to bring more people on in this war for talent as things start to shake out. But to the point that you're making here, the market cannot absorb all of these jobs. UBS and Credit Suisse combined would make one of the largest banks in Europe by head count. That is 123,000 people combined, UBS being the larger of the two firms. And remember, investment banking jobs here are also likely to be cut as UBS streamlines that investment bank and looks to maintain profitability there. Again, 36,000 jobs. Credit Suisse had a plan to cut 9,000 over time. This would go well above and beyond that for both firms.
Yeah, tripling them. And there's a question of how heavily they're going to weight that to the Credit Suisse side rather than the UBS side. Meanwhile, over in the consumer-facing sector, McDonald's, Abigail, sending home to do it virtually. Please explain.
It is really a pretty interesting situation here, Lisa, and it's a well-communicated layoff because back in January they did talk about difficult decisions ahead relative to staffing levels as they're trying to make changes for their chain overall. An email last week went out to U.S. corporate staff along with some international corporate staff saying Monday through Wednesday, please work from home. We are going to be making these layoffs virtually. Now, it's not clear how many folks will be laid off. They do have more than 150,000 corporate staff around the world. Now, they've been making layoffs since 2018. This could be one reason why the S&P 500 has underperformed McDonald's over the last year. Back in 2019, they had more than 200,000 employees, corporate staff. So again, reduced by almost 50,000 over that time period. So some investors may think that this company is dealing with it better. And speaking of dealing with it better, Lisa, obviously McDonald's is joining UBS. There's so many companies laying folks off as we come out of the pandemic, inflation, Amazon, FedEx, Disney, GM, just to name a few. McDonald's, the latest. It will be interesting to see how many folks are laid off from those more than 150,000 corporate staff worldwide and what the impact is.
Abigail, Shonali, both of you, thank you so much for that. Sri Sankaran and Kathy Jones still with us. The year of efficiency, we heard that from Meta, and we continue to see that. Sri, how do you determine whether this is really just getting rid of extra fat versus cutting the bone in the face of a real margin squeeze and potentially economic softness?
I think some of it you would see in terms of the nature of job cuts being announced, right? So, I mean, to the extent that these are large tech companies or some of the larger consumer names that you were just talking about, I mean, it does feel like that could be, to some extent, the excess labor force being trimmed. But to the extent that you see those job cuts start to transmit more meaningfully into the smaller companies and small and mid-sized companies, I think that's where it becomes clear that this is the credit tightening and the access to liquidity and some of the kind of more adverse side of the credit conditions doing or catalyzing these job losses rather than just trimming of excess labor force here. But I think a couple of things there. Oh, sorry, go on.
No, please continue.
Now, I was just going to say that the tension here is between the thesis that companies would still have to hold labor because of the experience of COVID versus kind of prioritizing survival and liquidity in an environment where credit availability is squeezed much more significantly. It's not clear which is going to overweigh, which was going to be the heavier, doing the heavier lift here. But our house call is for a little over 4%. So not a material increase in unemployment rate because it's still the hoarding thesis that we're saying will dominate.
Sri, I was just overexcited by what you had just said, and I'd love to get Kathy's view on that. This question of the job cuts that we're hearing announced, a direct consequence of the credit tightening that we're seeing on the part of banks. Kathy, would you agree with that assessment?
Well, I think that's part of it, but I think we're also, if you look back, the Fed's been tightening for well over a year now at a really rapid rate to slow down the demand side of the economy and rebalance the labor market. And I think the outcome that we're seeing now is that companies that had expanded very sharply during the post-pandemic time period, with the reopening time period, are starting to dial back, but also saying that, demand on the ground is slowing, and that means slower growth, particularly for some of the high-flying companies. And as they lay off, that has a ripple effect throughout the rest of the economy. So we do think it will filter down into smaller and medium-sized businesses that have actually been doing pretty well. That's where the job growth has been heavily concentrated, and we think that that slows down materially in the second half, more because of the cumulative tightening we've seen from the Fed than just the tightening in financial conditions in the last couple of months.
Sri, at what point, given that you and Kathy seem to be in agreement with a lot of this, do you see a potential buying opportunity for riskier credit again? I mean, how far away are we from that if you still see so much pain still yet to be worked through the system?
I mean, that is going to be a question of two things, right? So one, with respect to the economy, I mean, clearly the risk is that you do see a more pronounced kind of a recession set up going into the back half of the year. That's not what our base case is, but to the extent that some of these kind of adverse extraneous factors contribute to that, that means that you still want to buy time. And that's kind of where we are now. And the second aspect of it is just the valuation side of the story, right? So we did see some degree of decompression within the credit market. Some of the lower quality portions of the market start to sell off more meaningfully, but that was as short-lived as ever. So in the past week, again, we've seen some degree of a snapback, and some of the financial repricing obviously confined more to the regional, smaller bank space, et cetera. We don't want to see more of that valuation story get favorable, and the market start to reflect or price in more of the recession risk, because that's kind of changed over the past week, but valuation of the past month, but valuations haven't really moved as much.
Sri Sankaran and Kathy Jones, both of you, thank you so much for being with us this morning. Coming up, the morning calls, and later, an unforgiving earnings season. Why Chris Harvey of Wells Fargo thinks results that miss could lead to bigger punishments. That conversation around the opening bell.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Bernstein upgrading Intel to market perform, saying the macro setup is finally starting to improve. Next up, JP Morgan upgrading Macy's to overweight, highlighting the stock's favorable risk reward at current levels. And finally, Morgan Stanley downgrading First Solar to underweight, seeing limited upside with benefits from the Inflation Reduction Act already priced into shares. This is Bloomberg.
technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
I'm Lisa Abram was in for Jonathan Farrow. Starting the next quarter with perhaps a bit of softness, you're seeing the NASDAQ leading the declines lower, 0.7%. S&P off by just 0.1%. Really, the Russell 2000 gaining about a quarter, given the fact, 0.25%, given the fact that the small, regional, and bigger banks are all doing well, given the fact that we did not get any news over the weekend about banking crises, so perhaps banking crisis over. In the other space, we're seeing yields higher on the heels perhaps of what happened with OPEC Plus cutting production by more than 1 million barrels, crude prices up by more than 5%, almost 6% on the NYMEX. Same with what you're seeing over with respect to crude, and a little bit of dollar weakness pretty much across the board. OPEC really leading the charge this morning, delivering a surprise production cut as Q2 gets underway, setting crude prices higher, which we just saw, sparking a rally as well in energy stocks following somewhat brutal month for the sector that we just saw. For more, Abigail Doolittle. Abby.
Yeah, big gains there, Lisa, for some of the big oil companies today. And it's interesting because oil, you were mentioning the rough month. It's actually been a rough 5 months for oil, down 5 months in a row, the longest losing streak for oil going back to 2015, as traders really assess what's going on coming out of the pandemic. Of course, we had that supernatural rise, plus the inflation pressures. But right now, oil is, of course, popping up more than about $5 for both WTI and Brent crude. And technically, we have oil set to go back toward $90. This is a very reliable range. Oil now back above its $50-day moving average, going toward the yellow 200-day moving average. That's a fancy way of saying the long-term traders may get more reinvigorated here. In fact, some analysts are saying that because of this OPEC Plus cut, that it puts $100 per barrel back on the table, as we saw last year. Now, interestingly, even as we've had oil on the decline over the last several months, that has not been the case for big oil. Some of these companies really figuring out how to manage it. If oil does increase, Lisa, it seems pretty clear that it could go right to the bottom line of some of these big companies. One reason that we do have some of these big oil names higher, and energy right now up 3%, the best sector on the day.
Abby, thank you so much. Meanwhile, over in the merger sector, you're seeing something different for WWE, that is World Wrestling Entertainment. Shares falling after Endeavor struck a $9 billion deal to buy the firm. The CEO saying, quote, given the incredible work that Endeavor has done to grow the UFC brand, this is without a doubt the best outcome for shareholders. Let's bring in Bloomberg's Katie Greifeld for more, evidently the WWE expert. Katie, why is this not perhaps getting the most enthusiastic response from shareholders?
Well, Lisa, let me
just start and say that this is huge news in the world of televised combat entertainment, which I learned a lot about this morning. So the combined company, it's going to be valued at more than $21 billion. And like you said, Vince McMahon came out and said, this is without a doubt the best outcome. But you do see shares falling right now, currently off about 7% or so, because a counteroffer is seen as unlikely. Those are the words of Wells Fargo. So that could explain the reaction that you're seeing in the shares. Let's get into the numbers, though. Endeavor is going to control 51% of this new company, and Ari Emanuel will take over as the CEO of that new company. And this deal, it values WWE at about $9.3 billion. Wells Fargo, again, said that the reported bid implies an offer price of about $102 per share, which WWE, it's never seen that number. If you look at a long-term chart of this stock, the all-time high is just below $100. That was reached in April 2019, and we had been getting closer. Shares closed at about $91 on Friday, but as you can see, with today's plunge, currently now off about 9% or so, we're back below $84.
Katie, our televised combat expert, thank you so much. Turning now to technology, Telus' first quarter deliveries falling short of Elon Musk's goal. Even though they did come in at a record, shares following down after a host of price cuts led to a record quarter for the stock. Bloomberg's Ed Ludlow joining us now from San Francisco. Ed.
Yeah, good morning, Lisa. Both Tesla and Rivian, its kind of plucky rival, lower in this early exchange of trading. Actually, Rivian now flat, modestly higher after both of their first quarter deliveries beat expectations. For Tesla, 4,222 vehicles, above street expectations, but as you said, it isn't enough to keep them at that 50% annual growth rate that Elon Musk has talked about. This was a fresh record, and you can see that it is also a gain from the prior quarter where output had been ramped up. The concern the street turns its head to is margins, because this was a result of price cuts that Tesla had done in multiple jurisdictions, including the United States and China at the beginning of the year. You'll remember that Elon Musk talked about demand running at twice the rate of production in those early weeks of 2023, directly stemming from that price cut. The other data figure that we look to, though, or data point that we look to, is that this was the fourth consecutive quarter for Tesla where production exceeded deliveries. Once again, Tesla talks about a high number of vehicles, particularly Model S and Model X, being in transit at the end of the quarter as the company moves to a more even mix of production across its factories in multiple regions, the United States, Europe, and China. But shares a bit low. You have to remember the run-up in the stock this year, above 60% after what was a difficult year for the stock in 2022.
Ed Ludlow, thank you so much. Meanwhile, the warnings for Wall Street are piling up. Chris Harvey of Wells Fargo delivering the latest one, writing, quote, "The first quarter will be one of the most unforgiving earnings seasons in some time. It is still difficult to identify the most at-risk companies, but the more cyclical firms could see some of the bigger penalties for EPS weakness." Chris, I am so pleased to say, is joining us now. Chris, let's start there. Why haven't we seen such a real punishment from some of the earnings misses, which we actually did see during the first quarter?
Lisa, that's a great question, and we're not sure. But at the end of the day, what we're in a slowing economy. We're staring into a recession. The Fed is not going to bail you out. The economy is not going to bail you out. And if you can't make numbers, it's going to be a very, very difficult period. And it's going to be a very difficult year because typically we see serial correlations with these issues. We haven't seen this big pain, but typically before a recession or before a big slowdown, this is when we start to see things really change. And again, there's nothing that's going to bail you out at this point in time. Not the economy, not the Fed. And at the end of the day, it's going to be a very, very difficult season for some companies.
So this is what people thought in the first quarter as well. This is what heading into 2023, the likes of Mike Wilson were saying over at Morgan Stanley, and it didn't come to pass. People say that things kind of hung in there when it came to earnings. Not that much. Right. Actually, they weren't that great. Morgan Stanley's Mike Wilson just doubling down over the weekend, saying we see little evidence that a new bull market has begun and believe that the bear still has unfinished business. So he agrees with you, talking about tech's relative outperformance as really just hinging on the potential for stimulative aspects of the bank assets, which Federal Reserve assets have grown, but he really pushes back against that. So from your vantage point, what will be the key moment, Chris, where people kind of realize that weakness actually means weakness?
Yeah, so a couple things there, Lisa. The first thing I would say is for the last few quarters, we haven't had this stance, right? We think there has been more fear-mongering than fact. But now what we have is we had the banking stress, the banking crisis in the middle of the quarter. What we're going to find out, what we're looking for is what companies say. Do they say things were good up until the middle part of March and then things slow down, right? So if you go back to fourth quarter of 18, right? A lot of companies said, hey, we read the newspapers, we see what's happening in the stock market, but the consumer, our end markets were still strong. I'm not sure that's true anymore because you do have a much tighter Fed. We are long in the tooth at this point in time, and you do have real concerns on the funding markets. And the last thing is we have been seeing for a number of quarters margins starting to compress, and we think this is where it comes to roost. This is the period where you really have to, if you can't make numbers, if margins get compressed, this is where you get penalized. And this is the first of what may be several very difficult earnings seasons.
Chris, let's talk some tail risks. Is the banking crisis over?
The first thing I would say is we think the overall bank industry is very solid, very stable, okay? We think that things are very regionalized and probably could have used a better word, but the regional bank situation has stabilized, but there's still some idiosyncratic issues. We are going to see some of that play out during earnings season, but overall the bank situation is in good shape. And the Fed, the Treasury has a good job at backstopping things, and things have calmed down. But I don't think that the thing that we're facing and the thing that we fear the most and the concern that we have is we've crested on liquidity. Access to capital will be a little bit more difficult to come by in the second half of the year, and that's going to have economic effects. But overall, the bank space is still in a good space. The banking sector is working. We expect it to continue to work. This is not the great financial crisis by any stretch of the imagination, but there are parts of the banking space that still need some, that are still under a bit of stress.
It's especially under stress because rates are so high and people are taking their money out of deposit accounts and putting it in money market funds, which we've seen record inflows. To what extent do you see some sort of reduction in credit, this sort of credit tightening that everyone's expecting and eager to get on May 8th with that senior loan officer survey? How much is that going to really tap how far the Fed can raise rates and even cause them to cut?
Yeah, so again, a couple things there. If you look at the senior loan officer survey, we've already seen conditions tighten, and this is before SVB. So you would have to believe that conditions are going to tighten even more, or somewhat more, as we go forward in time. Right? What does this all mean? This all means that we're going to have more friction, that the liquidity that we had over the past couple of years, you can't rely on that anymore. And what that means is that risk, for the most part, is probably not priced correctly, and we're going to have to see a repricing of risk because of different liquidities. And the last thing I would say is you are hearing from the powers that be that we probably need more regulation in the banking space. Regulation and liquidity don't usually go hand in hand. What they're talking about is, for some companies, raising liquidity, raising capital, and that's going to have an impact on the availability of credit. If you're good credit, you still will be able to get it, but at the margin, it's going to become more difficult, and risk-based capital will become more costly.
So isn't this just an argument for big tech? And a lot of people are pushing back right now, saying that it's not necessarily interest rate sensitive, but if they already have sold off somewhat, if there are definitely efficiencies that are getting sort of bled out, and these are not companies that are going to struggle to get credit, are they sort of defensive stocks right now?
Yeah, Lisa, so our price target for the S&P 500 is 4,200. It's 20 times on 210. The reason why we got there, and those are pretty healthy numbers, but what we were saying at the beginning of the year is we think rates will come down. This will be a good environment for growth. The economy will slow down. That's also a good environment for growth, and the S&P 500 is a growth index. And so the answer is we've wanted long duration. We thought growth would come back. This is the environment that growth does come back in. But what we're seeing, too, is we're seeing some of these longer duration assets really run up in the short term. We do expect to see some pullback. The place that we think that's lagged a little bit, not a ton, but a little bit, is mid-cap growth. And that's a place where we want people to put new money to work.
Chris Harvey, you'll be sticking with us. Coming up, we'll hit oil. OPEC's cut stoking U.S.-Saudi tensions.
It was definitely designed to boost oil prices. I don't think we're staring in the face of 100. We're certainly flirting with a market which could see more demand in the spring and summer.
That conversation still ahead.
you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It's the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Well, we're coming back now with a report on the S&P Global U.S. Manufacturing PMI. It's a slight tick down to 49.2, which is just below 49.3. Statistically meaningless change, but it does suggest that manufacturing is still not picking up in the United States. Same story in Europe, where we saw most of the countries over there, the biggest economies, also in the 40s for their manufacturing PMIs. Question now becomes, how does the ISM turn out at the top of the hour? We are expecting at this point a 47.5, which would be down a little bit from 47.7. That'll be the big number to trade on today.
Michael McKee, thank you so much. Tension simmering, meanwhile, between the Biden administration and OPEC Plus after a surprise production cut, Saudi Arabia leading the way by pledging its own 500,000 barrel a day reduction. The White House calling the move ill-advised and vowing to focus on lowering prices for consumers. Bloomberg's Anne-Marie Hordern joins us now with more. Anne-Marie, do we have a sense of what the administration's response is likely to be?
Well, they said it's ill-advised, and Lisa, this surprise cut over the weekend, Sunday surprise from OPEC, was a little bit of Sunday scaries for the Biden administration. What RBC's Halima Cross has said is that obviously these Gulf producers, they are pursuing their own economic interests, but the Biden administration has their own interests as well, and that's keeping a lid on oil prices and gasoline prices. What we could potentially see is they could tap the SPR again. Remember, they have been making this historic taps of the Strategic Petroleum Reserve, trying to make sure they can quell an oil price rise that was inflicting on gasoline prices as Putin was invading Ukraine. The other thing you may see, and this would be a lot more political posturing, but there is this NOPEC bill in Washington. And what this would allow basically the United States to do is go after countries that are part of this cartel, even suing them. Now, I'm not saying this is going to get past the finish line, but when you see movements like this, these are the kind of conversations that start to come up to the surface.
Anne-Marie, just quickly here, some people would say that perhaps the U.S. thinks too much of itself in this particular case, that perhaps this is really just catering to China, and it's quite clear in Riyadh that China isn't going to have the same kind of demand for energy that it was perhaps before we really got a sense of what the reopening would look like. How much credence do you give that kind of line of reasoning?
To be honest, I do really believe this is Gulf producers looking out for their own interests. When you look at especially what's going on in Saudi Arabia, obviously no OPEC minister will come on or leader will say that they want higher oil prices, but they'll say they want a supply and demand. But clearly, this benefits their economies. Also, when you look at what's going on in the kingdom right now, they obviously took a huge hit when it came to the collapse of Credit Suisse. So I truly believe this is more about their own economic interests than trying to play this hand to China.
AMH, thank you so much for being with us. Chris Harvey of Wells Fargo back with us. Chris, how much does it change the game that OPEC Plus is cutting production by more than 1 million barrels a day?
I think it really does. And now the question is, what the Saudis look like they're doing is they feel like they have leverage. And now this is going to create a back and forth. But at the end of the day, I agree with the other commentator. They're looking out for their best interests. Right? And one thing that came out recently is if you look at energy production in the United States, 20% of the electricity production in the United States, 20% of it is from renewables, which is, I believe, slightly more than coal. That is something you couldn't imagine 10 and 20 years ago. And so the hydrocarbon space is under pressure, it is under attack, and they're going to do what they think is in their best interest, which may not be aligned with our best interests and our consumers.
Well, Chris, do you take from this that oil prices are going to be higher, or do you take from this that perhaps growth is slowing more substantially globally, and that's going to feed back into other inputs as well?
And Lisa, let me just talk about a big picture. What we think is that we're going to have higher lows and higher highs because in the United States, there's a disincentive to invest in supply. And that's going to create a difficult situation. The only thing that's going to change is price. And so we're going to have a situation where the lows aren't that low and the highs continue to march higher overall. As far as the short term, that's hard for me to tell. But overall, because of some of the supply issues, some of the incentives, and some of the policy, you're just not going to have the supply that you want that's going to bring down price the way it has in the past.
So, Chris, are you bullish on energy companies just in general? Do you think that those stocks still are really going to be the ballasts?
So right now, we're neutral on energy. We are looking at the pullback. There are a lot of really attractive companies in the energy space. The energy companies have done a fantastic job at restructuring their balance sheets, at doing shareholder-friendly activity, and we think there's a lot of value and a lot of quality there. The one issue that we have is we do think we're going into recession. We do think things are slowing down, so it may not be tactically the opportune time to get aggressive on energy just yet.
How different is your outlook today than it was, say, at the start of the year when it comes to what's defensive and what's not?
Not too different. So at the end of the year in December, we did downgrade some of the staples because we thought valuation wasn't that attractive, and what we thought was going to be defensive sector-wise was pharma because of valuation, because of the underlying fundamentals. We also thought that better balance sheets would be more defensive, and we remain in that camp, and actually we think that's the place that you really want to be. And one of the things I think you're implying is what you're seeing in the marketplace is Uber caps or large cap growth or technology appear to be the new low vol. And to some degree, we understand that. But it's also because when you're in a banking crisis, when you're in a situation where there's stress, you want to have those better balance sheets, you want to have those stable growers, and people have run to that. But it does look like that's a little bit stretched in the short term. But overall, those balance sheets do look pretty attractive to us.
On the flip side, do you fade some of the home builder stocks?
It's not so much we fade the home builder stocks. What we're fading is we want to fade risk, we want to fade cyclicality, and we like growth or GARP over value. We think we're going into a slowing economic environment where credit is going to be more difficult to fund, and we're late in the cycle. And here's the thing that we keep coming back to, right? We're close to our near-term price target. As we look forward in time, it's heads we lose, tails we lose. Because financial conditions, in all likelihood, are going to tighten. They're either going to tighten related to the banking crisis or the banking stress, or they're going to tighten because we've resolved that, it's in a good place, and the Fed will get back on its horse and start raising again. And so we're looking at a situation where financial conditions, almost no matter what, tighten, and that's just not a great environment for risk and risk product.
Chris Harvey, thank you so much for taking the time. Have a great week. And now let's take a look at some of the sector action. We've seen a lot in the energy stocks. Abigail Doolittle on deck. Abby.
Hey, Lisa. Well, of course, energy is the top sector on the day, up more than 5%. A really classic risk picture here. We do have small gains on bottom utilities, along with some of the tech companies as yields go higher. Relative to energy, it's a 7th up day in a row, the longest winning streak since last October. And we also have, or excuse me, today's 5% pop, the best day since last October. That streak, the best since last March, Lisa.
Abigail, thank you so much. Coming up, the market moving events that you need to be watching. That's next in our Trading Diary.
don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg The Open. Let's take a look at what's going on right now. About 25 minutes into the session, we see the Russell is actually gaining the most, up 0.3%. S&P up 0.2%. Still in the red for the Nasdaq, perhaps on the heels of some of the increase that we're seeing in yields, down about 0.5%. Time now for the Trading Diary. What you need to be watching this week: ISM manufacturing coming at the top of the hour. President Biden discussing his economic agenda for Minnesota at 2:30 Eastern. On Tuesday, Credit Suisse holding its annual shareholders meeting, plus Fed speak from Cook and Mestard, followed by Bullard on Thursday. And finally, on Friday, yes, it's Good Friday, but it is also the main event, the U.S. payrolls report to close out the week with potential perhaps for a softening, but not that much. People still, Citigroup among them, expecting more than 200,000 jobs created. This was Countdown to the Open. This is Bloomberg.
Did Art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article,
Connection
The
lost.
Get-Rich-Quick Scheme that nearly killed a German soccer team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network